Lindsay, Jeff and Bruce and Mark, Diane, Bruce there, Diane there. It was, let's see, I can look. Can't I? We got Jeff and there's Mark. And Jeff's with us. So we have one more minute. We ready, Dan?
Yep.
All right. Well, let's call the meeting to order. It's April 20th. It's 11:15 and call regular meeting of the Montana Board of Investments to order. We are recording this meeting, so please remember that. And Lindsay, if you'd call the roll.
Sure thing. Good morning, everybody. Carl England,
Here.
Jack Prothero,
Here.
Jeff Greenfield,
Here.
Bruce Nelson,
Here.
Diane Fladmo,
Here.
Maggie Peterson, Mark Berry. Oh, he's here.
Mark's here. He's on mute, but he's here.
Jeff Meredith
Here.
and Terry Cohey is absent. We have 8 board members present. We do have a quorum.
Okay. Are there any members of the public who wish to make comments on issues within the board's jurisdiction? Lindsay, I don't see anything. Do you?
Nope, nothing on my end.
All right. We have a couple of sets of minutes to approve. Let's start with February 23rd, 24th. Any additions or corrections? And if not, is there a motion to approve the February 23rd, 24th, 2021 minutes?
I'll move the February 23rd, 24th minutes.
Okay, Mark's moves. There a second?
Second, Diane.
Diana, second. Any discussion? If not, all in favor say aye. Aye.
Aye.
Any opposed? None. Motion passes unanimously. We have minutes for the special board meeting of March 23rd, 2021. Any additions or corrections? And if not,
I have a question or comment. I don't know if it's changed or not, but under item 5, the RFP, it says that Mark Berry moved to approve the custodial bank RFP as presented, but we received a copy of the RFP and we made comments back, and staff went through a listing of changes, but we didn't see those changes made. So I'm just concerned about the characterization of these as presented. It's as presented with changes, if anything.
all right, with that correction, is there a motion to approve?
So moved.
Okay. Second,
This is Diane. I'll second.
okay. Any discussion on the motion to approve the March 23rd, 2021 minutes as as changed with Mark's point. If not, all in favor, say aye.
Aye.
Any opposed? None. And we'll go to audit committee report. Maggie?
It was a quick meeting because Executive Director Villa didn't have any comments, so I'll go past that and go right to the audit checklist. Julie Feldman presented the revised or updated audit checklist and just some of the points of things they updated. On March 9th, they presented the Unified Investment Program and Enterprise to the Legislative Audit Committee. WIFLE has conducted their entrance conference, and they're going to perform walkthroughs the week of May 17th and testing the week of July 26th. She spoke to the SOC reviews of some of the third parties that provide services to the Board of Investments. And she indicated that there were no deficiencies noted in those reports. She also noted in the checklist that the custodial RFP was released March of 2021 with a tentative award in September 2021. She then went on to discuss the continuation of operations plan, or the COOP plan. I think the main points there is that they had, part of it is to eliminate the backup location, because all of our staff now have state-owned devices, so they have access from their homes. I think the other thing was to get rid of, I thought which was minor, the management information systems and employee use form, because it's no longer necessary. And then I guess the rest of them were just real minor, like terminating employees, having a checklist, a new exit checklist. Procurement cards, now Executive Director Villa will have the discretion to manage the number of cards that are issued to staff. So with that, the committee recommends approval of the updated continuation of operations plan, and I would make as amended for minor editorial corrections that will be sent out to staff as per Mark Berry's request, and I would make that motion, Mr. Chairman.
Okay, and I think you mean sent out to board
I meant to send it out to board, I'm sorry.
now. Okay, that's the motion. Is there a second?
This Jack, second.
Okay. Any discussion on the motion to approve the updates to the continuation of operation plan? If not, all in favor, say aye. Aye.
Aye.
Any opposed? None? Maggie, one more decision for us?
So the internal control policy, I already touched on this. I apologize as some of the stuff that I thought was in the COOP plan. I just apologize to the board here. The first was the information technology systems, getting rid of that form. The change to the checklist, the new checklist for employees, and the procurement cards and the backup operations center being eliminated. So with that being said, there were a few minor typos in that report, and I would the committee recommended approval. I would make the motion that we approve the internal control policy as updated, and that copies of the revised policy be submitted to board members as requested.
Okay, there's a second?
I'll second.
Okay, Mark seconded. Any further comments or discussion, public comment, anything? Seeing none, all in favor say aye.
Aye.
Any opposed? Hearing none, the motion passes unanimously. Anything further, Maggie?
No, that's it, Mr. Chairman.
Okay. Jack, a report on the loan committee's meeting? I know we were all there, but for the record.
Okay, thank you, Carl. The committee met today. We had one loan request for Gardner Business Properties, which is a gas and convenience store that was recently built in Gardner, Montana. We're participating with First Interstate Bank. The total loan is $4,425,000 Board of Investments loan amount will be $3,318,750. It's a 20-year loan. And the board, the loan committee had some questions that were all answered, and that the loan was formally approved by loan committee unanimously today. And it does not, because of the loan amount, it does not need a full board vote here. This is just a report. And that was the one loan that we discussed at the committee today. I'm certainly open for any questions.
Okay, anything from anybody for the loan committee? Seeing none. Human Resources, Diane, you chaired that today in Terry's absence.
I sure did. In Terry's absence, there were no motions or decisions made today. We did take the time that we had in order to discuss potential projects for this summer and beyond. One of those was looking at our governance documents and perhaps considering changes in the format. And so no decisions were made, but certainly we just discussed that potential. And then upcoming items for the board's consideration later this summer. It sounds like there'll be plenty of opportunity for board work in HR and other areas. So we may have to schedule a work session. So we may have some additional meetings scheduled, but no motions were made today, and just a general discussion.
Thank you. Any questions for Diane or from anybody, or additional comments for anybody who's present? Seeing none. Comments from the TRS and PERS board members. Jeff, you want to talk about TRS for a minute?
Sure. Our last meeting was again by a Zoom, and hopefully that will be one of the last. Getting tired of following along, just looking at screens. I like to see people's faces, so I kind of hope to see all of you next time as well. We did a little bit of board training on some policies. The good news from the last meeting was we had a long-term, probably 10 years plus, contested case that finally ran out of appeals, so it is behind us. And we did settle another contested case. Each of these has to do with benefits that they believe they are supposed to get compared to what the calculations were. That was settled as well. And our next meeting is in 2 weeks. So I'll have more to say at our next board meeting.
Thanks. Any questions for Jeff? Maggie, PERS report?
Okay, we met on April 8th. It also was a brief meeting. I think the main points that we discussed, or issues we discussed, was that we approved the 2022 budget. We had a new board policy first review on correction of benefit payment errors presented by our attorney, Holly Ressler. That was Bill Hollahan and Holly Ressler. We also, the most time-consuming part of that meeting was dealing with an issue in Billings, where the Billings Airport maintenance / firefighters are asking to leave PERS and become part of FERS. And this was a request for a declaratory ruling by the MSFA. And we ended, I think the recommendation at the end of the discussion was that the city of Billings be allowed to present their response to this declaratory judgment request, and then that following that MSFA have a chance to respond to that. So nothing was really decided at that time. That's it. That was brief.
Okay. Any questions for Maggie? Seeing none, next item on the agenda is the comments of the board legislative liaisons. I don't think we have any appointed at this point. Is that correct, Dan?
Mr. Chairman, with the rollover of the legislative session in January 7th of this year, we are expecting new appointments from the speaker and the president upon sine die of the session.
Okay. So we have nothing there, so we can turn to tab 2 and executive director reports, Dan.
Mr. Chairman, I will move to agenda item E under tab 2 to begin with administrative rule review. Mostly because we have to send these to the Secretary of State by noon in order to get them posted for this register. Staff did not receive any public comment since your March 23rd administrative rule hearing. There's been no change in status, and staff does recommend adoption of the administrative rules amendments as presented.
Okay. Are there questions? Well, let's see. Is there a motion to that effect, please?
So moved,
Mr.
Diane.
Chairman, this is Maggie.
Second, Diane.
Okay. Any discussion or questions or anything? Dan, Dan White, you sent me the paperwork to sign it in the event of a positive vote here. I did that, correct?
Yes, Mr. Chairman.
All right. See? I can do what I'm told every now and again. Any discussion? Public comments? Anything? If not, all in favor of the motion to revise our rules? We don't need to read the list of the rules to be revised again.
No, please, no.
Even though it was the best reading of rules to be revised, you can. All in favor of the motion, please say aye.
Aye.
Any opposed? None. Motion passes. Dan?
Thank you,
wanna
Mr.
go
Chairman.
back?
I will send those off right away.
Thank you very much. Dan, back to you.
Okay, you have the monthly snapshot as well as website traffic. Legislative update. Briefly, the board has taken very few positions on bills this session. I think I've only had to testify 4 times. We did coordinate with the Department of Administration, Department of Natural Resources, Governor's Office, Department of Commerce on a banking bill that posed some risk to our bond program. We were able to work with the drafter or the requester of the bill, as well as the Montana Bankers Association on some consensus amendments. And that bill will now be signed into law. The 2 Chinese divestment bills were defeated in the Senate State Administration Committee unanimously. And the Israel divestment bill that has come up, I think the last 3 legislative sessions, was also defeated in the House State Administration Committee as well. Other than that, we haven't really taken many administrative positions. It's sort of been back to the original strategy of just keep our head down and do what we do well, and not a lot else. We did include the all exhaustive legislative bill tracking list. This was from the day before mailing. So it's as of the 5th of April. This is just sort of how internally we keep track of bills, which ones we're tracking, watching, opposing, being informational on. So happy to answer any questions on those if you have any. Otherwise, Mr. Chairman, I think I got everything out of the way in our committee work, and happy to move on.
Yeah, I've got a question, Dan. What happened to, I guess it was a resolution on an interim pension study?
So that is continuing in the process. Representative Garner out of Kalispell is carrying it. Unlike the work that happened in the previous legislative sessions, BOI will have the opportunity to participate in that interim committee should it pass and be ranked. One of the things that happens with the legislative study resolutions is all of the legislators vote on what they want to study, and then they allocate time from the legislative council to those individual studies. So it looks like it's going to pass if it hasn't already. So we'll just wait for the ranking process by the legislators. And then we've got a seat on the table at the table along with Impera and TRS.
Okay, thank you.
Yep.
Mark, did you have something?
Back to, I have questions about, back to Dan's report, item E, this discussion about how we want to move forward on the administrative rule
Oh.
change.
Yes, I apologize. I should have touched on that after the vote. So the recommendation before, or I guess not recommendation, but I think we all went through a learning experience on the 23rd, and board directed staff to come up with a process for you to consider on adoption and changes in administrative rules. What I've outlined for you is that process that at least I'd recommend you consider for policy adjustments. And essentially what it would be is Dan White as chief legal would act as the hearings officer, as Carl did as chair at the last meeting. I would then present the rule changes on behalf of the board. We would we'd go through all of the public comment, response to public comment, but then we would bring that all to the full board for your consideration and additional public comment before we actually go through before you vote on it. So essentially what it would be is we'd add a layer at the staff level prior to the board's consideration of administrative rules. But we would take care of the formalities that you all had to, I'll say, endure on March 23rd.
Mark?
So the way you got it laid out here, Dan, is we wouldn't see it. The board would not see this until it goes through the whole hearing process, comment period, and you made changes. So we wouldn't see what the staff is proposing for rule changes until it's pretty much a done deal.
If I wanted to lose my job, that's how it would go, yes. But there's no scenario under which we'd start an administrative rule process without getting your, at least a heads up email or something to that effect.
Okay.
Remember, the process that we outlined in these rules is to get as much of it into board policy as opposed to administrative rule as we possibly could. So, most of the administrative rules were duplicative or in direct conflict with the board's policies. So what we want to do is consolidate as much of the authority with you as a quasi-judicial board as we can, not having that adopted through the administrative rule process. In those limited instances where there would be the necessity to adopt administrative rules, we would come to you first and say, hey, this is out there. We need to do something about it and start that process. But I guess to your initial point, that's how it could work if I was at 30 years and 1 day in PERS.
Well,
So there's no requirement, I'm sorry, Mark, but there's no requirement that this is a question. Is there a legal requirement, Dan, that we approve starting the process?
Dan, if I can go
Dan
ahead.
White, I'm
Yep.
sorry.
Thank you. Mr. Chairman, no, there is no legal requirement at the beginning of that process. I anticipate what would happen is we internally, the staff would talk about rule changes that we think are necessary. Dan or I or both would come to you as a board with a narrative of what we think those changes are, with your then tacit approval of those changes. We've got some things in the loan program that we need to cover. They're better off in rules and in board policy. You would talk about that with us and say, yep, it sounds good, go ahead and do that. Then we would put together the actual official language. We may even come to the board with, probably will, with proposed language. Here's the rule changes that we are going to ask the Secretary of State to look at. And you give us the go ahead, and then we would go through the hearing, the proposed and hearing process internally.
Okay, just one quick question, Mark.
Yep.
We could have in our policy manual that stuff needs to be run by the board first, couldn't we?
Mr. Chair, yes.
Okay. Mark, I'm sorry, I interrupted you.
No worries. So what I'd like to see is, the staff would bring to the full board the proposed rule changes. The board could vote on those rule changes at that time and say, move forward with going through the rule process change or going through the hearings and all that sort of thing. Then after that, they can come back to the board and say, here are the results, so we're asking you to approve the final rules. That way we see it up front, because what Dan and Dan are saying is that they'll probably be showing it to us anyway.
Yeah. And
So I guess to that point is, if we go down that road, you're looking at least a 6 to 8 month process to amend your administrative rules, unless we do special meetings.
Yeah, you'd have to manage the calendar, that's for sure. And I know the calendars are for administrative rules are pretty strict, when you can present them and that whole process. I understand that, Dan, but are we going to have that many changes in rules?
So the staff goal is to have basically no more after this. We're kind of planning for, the apocalypse in this case, because our goal would be to have as much of it in policy as humanly possible, and amendments in the administrative rule only be a last resort. Timing, as long as the board is comfortable with a 6 to 8 month process for amending those administrative rules in that last ditch effort, staff has no problem with it at all.
yeah, if I
Go ahead,
could,
Bruce.
yeah, I'd just like to follow up because I agree with Mark. I think whatever we adopt here, and I understand the time frame, but whatever we adopt should be as explicit as possible about the board's role at the beginning of the process. So again, we don't end up, or a future Dan White, future Dan Villa end up in a situation where a board kind of gets surprised by something. For what it's worth.
Yep.
Mr. Chairman, Member Nelson, I totally agree. And I think we can administer this as you and Member Barry have suggested, that to bring you a draft of the rules first. There is a 180-day, that is 6 month time frame in which we have to propose to for final and then to get to final adoption. But I think that's workable if we have all of our ducks in a row when we come to you. It is always better to bring the rules to the board so that you can get a look at it. I agree with Dan that we don't anticipate doing much more in the way of rules in the future, but if we need to, what I would hope to do is to spare the board having to go through a long hearing process, especially where there aren't any comments. And it's common among state agencies to have the internal staff do the hearings and the notices, keeping the people apprised who need to make the final decisions.
Yeah, and given that we're not anticipating this happening very often, that to me is all the more reason to make sure that the process, again, is explicit as far as board involvement as much as possible. Not so much for those of us who just went through this process, but for future boards and future staff that, may not have experienced it before.
Well, let me ask the question, if I could. Is it worth just keeping the current process and making no change if it's going to be as infrequent as it has been? As painful as that was, if there's a concern that staff's going to get ahead of the board, why not just keep the current practice as it is?
If you're asking me, I don't need to go through the rules hearing and comment period.
Yeah, Bruce?
Yeah, I don't either. And, you know, I happen to be a little bit familiar with a major rules rewrite that I know Carl is aware of over at another government agency that my daughter was involved in as an attorney. And so, you know, having watched that from a distance, I think again that this is going to be infrequent, hopefully, but a good process that has the staff get the board's approval ahead of time on what needs to be done, and then conducts the process up to the point of approval is the best, both for the staff and for the board in the long run. So to your question, Dan Villa, yes, I think it's worthwhile for us to change the process so that the staff conducts the hearing and the responses to the public comment, and then comes back to the board with the final process, having had the process initiated with board approval at the beginning.
So let me pose a hypothetical. The board initiates administrative rule change. Staff goes through the public hearing and we receive substantial comment that we should not adopt or should adopt a different set of the rules. Is it board's expectation that we bring you amended rules, or is it board's expectation that we bring you the rules with the response to comment and then you amend the rules to reflect that? Because I think that would start a whole new process.
If I may interject, Mr. Chair, so that the board is aware of how it works in administrative rules. Typically, even with substantial comments, the staff on the board would look at those, respond to those comments from the public, and make changes that we think are necessary. We don't have to do that if we think that the rules as written can go ahead. But we can make those changes and then move ahead. The amendment process often ends up in additional hearings because of the substantial changes, or in the rule process starting over again, and that there are just some very specific rules with respect to that. So before you answer that question, I just needed you to have that bit of a background.
So
I mean,
my,
the real question isn't it, whether or not whether or not we have to in all instances be the ones conducting the public hearing. And it seems to me the answer to that from the board, from what I'm gathering here, is that we don't. And the rest of it, is going to fall into place how it falls into place. If you guys, if the rules that get drafted end up, because of the public comment, needing substantial changes, then we'll have to deal with that. Either way, we'll have to deal with that. Only if there's a second hearing, we don't necessarily have to be the ones doing the second hearing. So I'm inclined to think that we proceed like Bruce and Mark have asked staff to draft something up along the lines of what Bruce and Mark are talking about, and see what it looks like And in light of the fact that we don't do this very often, I wouldn't place this at the highest priority, Dan White and Dan Villa, as we have learned earlier.
Probably looking at a one sentence change in the governance manual to reflect that. So we'll work on that and bring something to you in June.
Okay, Mark, did you have something else to add?
well, I just comment that, like Dan White was saying, we see a set of rules, the board approves it, it goes through the hearing process. The staff come back to us and they can say, here are the comments that we received. We don't think we need to make this change. And if the board approves the rules without changes, taking into account that in a board meeting, we acknowledge the comments and we're good to go as far as.
And then as with all motions before the board, people would have the right to comment on it if they want to come again, so.
Yep.
Okay. All right, anything further on that? You guys have sufficient direction?
Yep.
All right.
Yes.
Dan Villa, anything further?
Other than you have the timeline for the asset liability study on item F. Discussed this a little bit, but happy to answer any additional questions. Otherwise, no, nothing further, Mr. Chairman.
Questions on the timeline of the asset liability study, Bruce, or?
Yeah, I don't have a question on those, but I do have a question, Dan. What's the status of the lawsuit over the with the Lewis and Clark County and the issue of the participation in PERS?
It is still at the district court level awaiting brief.
Okay, thank you.
Yep.
And it's a little uncertain because there's a district court judge in Helena who's up for confirmation.
Oh, that's the judge that this case is in front of?
I don't know if it's the judge that the case in front of, it's just that those 3 districts where there are judges appointed by Governor Bullock and
Oh, yeah.
they're trying to figure out what happens if their new
Okay.
person doesn't get appointed.
Okay, thanks.
Mark, did you have something?
Just a question. So if I'm looking at the timeline, then we expect that this study will be presented for approval to the board in August. Is that correct?
There won't be an approval for the study. It's just the RVK will conduct the study and the results will be presented to the board.
Okay, all right.
Anything else from anybody? Dan, we've got just a couple of minutes here. Is there anything about the monthly snapshot that's
Other than it's been a great year. The CIO takes full credit for all of the returns reflected on the snapshot. He made sure to put that in his self-evaluation that were turned into me earlier in the year. I think the only things of note is to continue to watch that STIP average yield. It just keeps getting a little bit tighter and tighter down there. We do have the new trust fund participants in that you approved at the last meeting. Those were funded at the beginning of the month. I guess the only other thing to note that ties in with the snapshot and the legislature, it looks like the legislation authorizing the coal tax trust to loan for coal mine remediation will pass. Reminder, they will have to go through our entire and full underwriting process in order to for staff to recommend any sort of loan in that space, but also a reminder, we could loan on that anyway. There's no prohibitions on those types of loans in statute. So it's just a very special call out in the event that a participating bank decides to lend for that particular purpose.
okay.
I have a question. Yeah, the MUS Group Insurance, that 2-month vacation, or whatever you're calling it, I remember seeing it when the legislative stuff. What kind of an impact is that going to have on this?
So it will be 2 months. I believe they're planning on October and November of fiscal 22. So that will be this coming October, November. My understanding is they can absorb it, is the message I'm getting from the budget office. I can't remember the specific dollar amounts, but it will be basically no new contributions in, but not an actual withdrawal from the assets that are reflected here.
That's what I was looking for. Thank you.
Anything else? It looks like, if I'm reading this right, we're breaking until 1, is that right,
That's right, Mr. Chairman.
at this point? And, those in Helena get lunch, and those of us someplace else don't.
We FedExed some Hot Pockets. Did those not arrive yet?
I think maybe Mark hijacked the FedEx, because
Could be.
yeah. All right, so we'll be back at 1, and those of us who are online, we just stay online, stop the video, and is that right?
Yeah, just mute and turn your camera off and you should be okay. Just make sure you mute.
Okay. See you guys. Ready, Mr. Villa, sir?
We are ready when you are, Mr. Chair.
All right, well, we're back on, back online, back on our meeting, back on the record, back recording. It's 1 o'clock and we have investment policy statements, John. And you can explain why we went from tab 2 to tab 5.
I was just gonna ask that.
So you don't have to. So the tabs are now established by a normal order. So you have tab 3 that's intercap, tab 4 that's in state, and then you'll start with investment policies on tab 5. So it's everything's in order.
We have uniform tab numbers.
On your, I think he's coming through your computer.
Yeah.
I can hear him. He's coming through something.
Okay.
Thank you.
We're going with the set of uniform tab numbers, right?
Uniformity is good.
Okay, well, I don't know that we made that policy, but I guess that's something that the staff. Anyway, John Ramasco, do you want to?
Yes, thank you, Mr. Chairman, members of the board. Again, a couple of policy changes for the trust fund investment pool. The first policy change is to switch from the Bloomberg Barclays Aggregate Bond Index performance comparison to a blended index that will include that index as well as real estate and high yield proportionate to their holdings in the trust fund investment pool. We're now a little north of 17% real estate in the TFIP, a little better than 6% high yield. So feel like a blended benchmark is a better representation.
Will that be harder to meet or beat?
Yes. Clearly it is, Jack, because we expect real estate and high yield to outperform core investment grade fixed income. So we won't have the benefit of a somewhat false comparison going forward. The second change there is.
Want to do these one at a time?
I should say, Mr. Chairman, this is the second change to the same policy.
Oh, I'm sorry, John.
The second change is to clarify a definition. We had a definition of core real estate in there that was somewhat difficult to work with. It defined core as being essentially all-inclusive, both geographically and by industry type. And so For instance, this building, which the fund holds, would, I think most of us would consider to be core, would not meet that definition. So we wanted to eliminate that definition to get to what is hopefully in the long run still a core portfolio, but might be made up of individual securities that might not all be considered core real estate. As part of that process, we felt like we had to, or we should, clarify the leverage requirements for the various subclasses, and you see those changes. The overall goal is that we think that we're going to have a core portfolio whose main purpose is to distribute income to the participants, but that money will be made up of non-core holdings. And it additionally gives us some flexibility to underweight potentially underperforming areas such as office space, retail space, some of the things that are part of a core portfolio but are somewhat out of favor right now.
Okay, John, anything more on the trust fund investment pool investment policy for your presentation?
No.
Okay, questions? Yes, Mark.
So I read, and I can't identify where I read it in this material, John, but it discusses core plus, but I don't have a definition of core plus anywhere either. Should there be?
There is no good industry definition of core plus.
Okay, but we're using the terminology.
We are using the terminology essentially to differentiate it from core and put parameters around it with leverage parameters.
Okay.
So Mark, if I might, really within real estate, even core, I mean, there's no real industry accepted definition, and Ethan can chime in or something if he wants, but core plus, they're kind of terms we throw around, but at the end of the day, the goal here is obviously to have within trust fund to have real estate that is by and large leased up and has tenants, and it's the majority of your return is going to be from the rent and the lease payments that you get off of those securities or off of those properties. The reason that we have core plus in there is we have certain funds that we may want to participate in, and we did one fairly recently where the vast majority of it is core, and they'll come to us and talk about this and say, well, the documents for the fund might be we have to have at least 75% core, and then 25% might be opportunities that we have for, let's say, infill in New York City or something, but we've got to build something from the ground up. So we're going to build a core property there, but it's going to take us, maybe 2 years to get that up and running. And so that's kind of the plus aspect of it. So at the end of the day, when they, are done with that fund, everything would essentially be core, but there might be some build to suit or some other things. And that's kind of the plus aspect of it. So it's hard to put a real fine definition around some of these things. We just want to make sure that we're, because we have it in the policy statement, we want to be sure that Dan Zarling and anybody else can, make sure that we're well within the parameters that we're putting around this, and that we can track the risk that we're placing into the portfolio. And so I know that's not a, perhaps super satisfying answer, that there's not this hard and fast, very,
clean definition for each of these things, but that's sort of the reality of the space.
Because you got core, you got core plus, and you got real estate debt. So you got 3 different types of real estate strategies here. So
Correct.
that's what. But I didn't see anything that defined core plus. And, is that something that the board should be concerned about?
At the end of the day, I don't think so. I mean, staff looks at that very carefully, and again, you know, I guess when we're talking about core plus, we generally mean that, you know, the majority of that strategy is going to be core, but it may have some aspects where they've got some plus-like strategies, so they have to do something, you know, whether it's maybe lease buildings up a little bit more than they already are, or build to suit, or do some renovations or something like that. But that's not going to be the majority of that particular strategy. It's gonna be the plus, I guess, if you will.
All right. Also, on whatever page it was. Okay, so on page 4, where we're having performance measurement, you know, we're talking about high yield, but then on page 8, I don't see any allocation for high yield. Is that something you add?
So I'm sorry, Mark.
Go ahead.
I was just going to say the high yield is part of the non-core fixed income. Right now, the only thing in non-core fixed income
Is high yield.
Is high yield. There's potential to maybe have some other sub-asset types.
Okay, I understand that. The reason I bring that up is because I looked at the state fund statement, and it does say high yield in the state fund statement.
So Mark, within state fund, we have not, we didn't think it was appropriate through discussions with them to add other types of non-core fixed income that we could potentially have here.
Except for high yield.
Correct. So we limited it to high yield in state fund.
Okay.
It's a bit broader in trust fund.
Okay. Well, you know, as a new board member, you know, and consistency helps me understand things in this investment world, because otherwise I'll get confused. So just to bring that up.
Okay, Bruce?
Yeah, does RVK have anything on this? Jim or Mark?
Well, I'll weigh in, and that is that the benchmark change that John Ramosko is referring to is clearly best practice, because it's reflecting the allowable sub-asset classes that would actually be in the fund, and proportionately, as he said. So this seems to us to be exactly the right thing. And he's right about the core and core plus. These are matters unlike in the world of rating agencies, for example, where something is you know, a AA or a single A, and it's either one or the other. Core plus can be any of a variety of things, and it's probably in the best interests of the board not to just limit it to core, which can be strictly defined by an outside party as a building that is completely leased up. And as John said, that could very well not be the case for every property that's in one of these funds. So I hope that's responsive, Bruce.
Yeah, no, that helps. Thanks.
Anything else? Anybody? I had a question on the, it's page 10 on the leverage, the new leverage sentence. Leverage for real estate debt is only measured at the fund level. Would you explain that to me real quick? I think I understand it, but.
So for instance, we have a fund that invests in commercial mortgage-backed securities. They would own a set of loans on buildings. This is not measuring, we're not going to attempt to look through a particular security to the leverage of the underlying assets. That's consistent with how most funds would operate. For instance, if you had a fund of bonds, you wouldn't necessarily look through each bond to see how much the underlying company would have in debt. So it's kind of an industry practice. Also, it's very difficult to accumulate that information. And so just wanted to be transparent there.
Jim, Boyko, you agree with that?
Yes, when you think about it, when you look at properties and you ask the question of leverage, a property fund, the leverage that you're talking about typically is the leverage that is applied to each individual building in the fund. And that aggregates to a fund leverage, but it's at the building level typically, although not always. It can be the GPs or the fund managers' debt that's used for transactions. But your staff is correct that when you're talking about a package of bonds, then the question becomes, are you leveraging the leveraged vehicle itself? And so measuring that leverage at the fund level is the right thing to do, because it basically tells you whether or not you have a fixed income investment or a leveraged fixed income investment. There's a parallel here in the equity market as well. When you own the equity in a company, you typically, as a matter of policy, don't look through and say, okay, let's look and add up the aggregate leverage of each of these companies we own stock in that's on their balance sheet. That is something that you would expect your asset managers, external managers, to do on a stock by stock basis, because leverage at the equity level, at the company level, is a potential factor in the performance and risk of owning a stock. But we have no issue with what your staff is recommending. In the spirit of being clear, Mark, does that resonate with you as well as the questioner?
You're asking me or Mark Barry? Sorry.
No, I'm asking Mark Barry.
Okay.
You're asking me?
Yeah, I wanted to make sure that we were clarifying things and not making them more difficult to understand.
No, that's fine with me.
Okay, anything else? Questions for John? Anything for RVK on this? If not, is there a motion?
Carl, this is Jack. I move to approve the changes in the trust fund investment policy.
Okay. Second, Diane seconded. Any further discussion, public comment, questions, comments? Anything for the good of the order? If not, all in favor, say aye.
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 Any opposed? Hearing none, motion passes unanimously. Ramasco, now we're going to Upper Clark Fork River Basin Reserve Fund.
Yes, thank you, Mr. Chairman. Much easier concept to understand on this one. The Department of Justice Natural Resource Damages Program does not expect any significant expenditures out of this account for an extended period of time. Their strong preference is then to increase the investment in the trust fund investment pool from 97 to 99%. The 99% is actually a limit that the board suggests just because there is some operating cash necessary. Happy to take any questions.
Questions? Billy, you know about this. Does this represent a change in policy or just an evolution of the fund?
Just an evolution of the fund. Missoula's already taken most of the cash, so everything that's left, we can just invest, and the headwaters will just have to deal with it.
Yeah, poor Butte didn't get a dime out of it.
Yeah.
Anything else? If not, there a motion to approve the change in the Upper Clark Fork River Basin Reserve Fund or investment policy for the Upper Clark Fork River Basin Reserve Fund?
I'll move.
Mark.
I'll second it. I'll second it.
All right. Maggie seconded. Any questions, comments? Public comments, anything? If not, all in favor say aye.
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 Any opposed? Hearing none, motion passes unanimously. Tab 6, correct?
Thanks, John. Yes.
Randy, there you are.
There I am. Welcome to, good afternoon, Mr. Chairman, members of the board. I direct your attention to tab 6, which does follow tab 5 this time around. We'll do a deep dive here into the international equities asset class. I'll start with a overview of the asset class, and then I'll get a deeper dive from there from Steve and Jason as well. You take a look at slide 2, we'll start there. The objective of international equities, in addition to providing diversification, is to provide the highest possible return within the parameters of the investment guidelines that are stated within the public retirement plans IPS. And so we manage according to that. It is the second largest asset class within the pensions, and currently the allocation range is 12% to 22%. Almost all of the asset class is managed by external asset managers that invest in the equities of companies that are located outside of the United States. And we have a combination of portfolios that those external managers manage for us that includes both indexed and actively managed portfolios. International equities are highly liquid assets, meaning that they're easy to trade, buy and sell, very liquid, pretty much as liquid as the US stocks, not quite, but still very liquid. They do provide high returns, but they also are high relative volatility assets as well, compared to things such as bonds and real estate. Slide 3. This is a pie chart which illustrates basically where the international equities sits within CAP. You can see down at the bottom right, 19% as of the end of the calendar year was international equities, second only to domestic equities at 33%. So very large, very important asset class with quite a bit of effect on the total returns for the pensions. And if you look at international with domestic, public market equities account for a little more than half of the pension portfolio. On tab 4, or slide 4, excuse me. Thank you. There are some differences between international equities and domestic equities, and we'll look at them here. First of all, the sector exposures are different in that there's quite a bit more financials in the benchmark for international equities compared to domestics, and there actually is quite a bit less tech, which the tech makes quite a bit of sense because we have those big tech stocks that carry such big weights in the US indices. One of the major differences between international equities and domestic equities is the currency that's involved. When we're buying and selling and owning international equities, they're largely stocks that are denominated in the currencies of those particular countries. So you can get these currency movements that will affect the returns of of those assets. And we'll talk a little bit about that on the next slide. But first, want to talk about the size of this universe too. There's actually a lower average market cap across the board for international equities, but there's over quite a bit more stocks. There's about 6,600 stocks in the benchmark that we use for international equities, as opposed to say 3,000 for the Russell 3000. So there's quite a universe out there for international equities as far as a number of stocks to choose from. There's two different types of equities within international equities that you can actually invest in. There's local shares, which we call ordinaries, and those make up about 90 to 95% at any given time of the asset class that we manage here. Those shares trade are denominated in the currencies of those countries. The other type of stock that we can invest in is they're called American Depository Receipts, or ADRs. And those are actually stocks that are denominated in US dollars, and they represent a certain ratio of local shares that you would own by owning that ADR. So for instance, one ADR may be worth 4 local shares in the yen denominated stock of, say, a Japanese company stock. Also, cash is largely foreign currency in this portfolio, which makes a lot of sense because, you know, as we're trading those local shares, mostly the ordinaries in those local currencies, when they're sold, we typically get paid in that currency. On slide 5 here, we'll take a look at the currency effects of international returns. And like I said, currency movements can be pretty volatile in the short term. They're really hard to predict, and they can impact the returns of investors by quite a bit, like I said, in the short term. Over the long term, they typically pan out, they typically level out, and long term, I mean like several years. But in the short term, these currency movements can really affect the returns of international or US investors in the international markets. For instance, if you have a strengthening dollar and it's strengthening versus, say, you own a Japanese stock and it's strengthening versus the yen, then it's actually eroding your returns because you're losing value being in the yen versus the dollar. So, you know, usually a strengthening dollar is a headwind, you might say, to the returns for international stocks. Conversely, if you have a falling dollar, then it's actually helping your returns because what the asset that you're in that's in the local currency is appreciating and is actually increasing your return versus the US dollar. That's kind of been the case for most of the past year because we've had a weaker dollar predominantly, not versus every currency, I wouldn't say, but overall. And so that's been helping the international returns to some extent for the last year. So that's a brief overview of the asset class. And I'll turn over to Steve now, and he's going to talk about the characteristics more so of the international stocks out there and the characteristics of the benchmark that we use.
I have a quick question.
Sure.
So if we get cash returns in foreign currency, right?
Right.
That goes to State Street, and then who converts that to dollars?
The managers have their choice. Typically, it'll be State Street, but the managers have their choice whether they do it themselves or whether State Street does that.
Okay. And is there any strategic decision in that, or is that just something that must happen within X number of hours or X number of days? Or?
Yeah, it depends on the liquidity of the stocks that the manager is moving, trading. And yeah, so, it could be something that maybe they'll, say they sell a Japanese stock and maybe they just will hold the yen for a while. Typically, they don't like to make bets against, a certain currency. So, it's kind of up to them on how they want to do that. But usually our managers aren't playing the game of trying to, I guess, enhance returns by by holding certain currencies versus others. We have them just manage stocks to manage stocks.
So is that part, so that's part of our manager selection, is that a manager that would be doing that would be not only managing stocks, but also sort of playing the currency game, would not be somebody that we would like?
Right. If we were to play the currency game like that, we probably would hire a currency manager for the overall asset class. But our managers typically just want to own stock and just manage stocks. In fact, they have the option that they can hedge currencies if they want to in the individual portfolios that they manage for us. But we've only had one manager out of, the entire stable of managers through the history of this program that's actually opted to do that. The managers would rather just not make bets on currency and just manage their stock positions. And like I said, the relationships between the currencies typically even out over several years. So to try and play that game in the short term is really not something that stock managers usually want to do anyway.
And in terms of, you said that it's either our managers or State Street that does the conversion.
Right.
And I mean, how does that play out? Is it mostly the managers or is it mostly State Street?
I don't know exactly what the ratio is on that, Carl. I know that the managers have the option, and I think most of the time they allow State Street to do that, but I'm not quite sure.
And with State Street, is it the same deal? Do they have discretion, or do we have some sort of agreement with them that they have to convert immediately or convert within X number of days or hours or weeks or?
Right. They're supposed to make conversions on a daily basis for us.
Okay.
And we don't get involved in that with direct guidance, I guess, to State Street on that. It's kind of like a securities lending type situation where they do that automatically.
Okay. All right. Thank you, Randy.
You bet. Steve, you're on.
All right, members of the board, pleasure to be with you again. I am on page 6. So what we have here is a breakdown of some of the common valuation metrics that we look at for the benchmark itself, which we'll get into a little bit more detail about the benchmark in a second here. But the point here basically is just to show that as of year end 2020, you'll notice that a lot of these valuation metrics are close to, if not at, the maximum, where we've measured this over the trailing 7 years, just as a function of data that we have easy access to, which is basically a reflection of how strong the equity markets have been in recent periods. So it's driven those valuation metrics again at or near record highs, if I can put it that way. So just a quick way to see, that's, the kind of performance we've had in equities. As Randy mentioned, there are 6,000 some holdings in total in that benchmark. Looking at page 7, again, this is, we alluded to this earlier as well, that there are more financials in this benchmark, less technology. In general, it's a fairly diversified, there's certain sectors, real estate and utilities, that tend to be pretty small. But other than that, you can see there's good diversified representation across sectors here within the benchmark, which is what we want to see. We want to have good exposure to lots of different sectors. So the benchmark is constructed in such a fashion. Looking at page 8, another way that we diversify is by country. And so this is kind of a dual breakdown of the actual country exposures that are within the benchmark. The pie chart on the upper left there breaks it down by the developed market countries plus one solid slice, which is that big orange one, represents emerging markets. Emerging markets as a percent of the entire portfolio or the entire index have risen substantially in the last couple of years, such that they now represent a full 30% of the overall international benchmark. Breaking that down on the lower right pie chart, that's basically exploding that 30% into the individual emerging markets that make that up, you can see that China and India make up nearly half of the total. Some other big markets in there, Taiwan, South Korea, looking for Brazil is a pretty big slice, and then some smaller ones. But again, just the idea here is to emphasize the fact that we're well diversified, at least from a benchmark construction standpoint, across countries as well.
So, Carl, if I could ask, how close is China to becoming out of emerging markets? I would consider it not an emerging market, I guess.
So ultimately, that is up to MSCI, which is the benchmark provider. I would suggest that they probably get a lot of pressure from China for that to happen. There are certain, there's a bevy of specific factors that MSCI looks at to determine whether something should be a developed or an emerging market. Things like how many days it takes to complete a trade, how convertible the currency is. There's like I say, there's a whole list of things they look at. And so I have not heard anything lately to indicate that they're actually interested in making that change. We speak to some of our index, our index fund providers like BlackRock that are in close contact with the index providers as well. And they've indicated to us that at least in the near term, which would be, probably the next couple of years at least, no indication of any movement in that direction. I'm going to talk a little bit here in a second about the index reviews and what happens when MSCI makes those kind of decisions. But one key thing to understand there is that they, before they make that kind of a change, they'll normally take input from the investment community. They'll say, hey, we're launching a consultation on, whether we think it's appropriate to do this at this time. And when they come to the conclusion to make that change, they'll announce it probably at least a year in advance, if not longer. So we would know far in advance of the change actually being made that they were planning to do it. But to your point, to your question specifically, no indication of that in the immediate term. So jumping over to page 9. So this is a cumulative return chart. I've run this over the past 15 years, which seems to me to be a long enough period of time to cover some business cycles to kind of see where we've come to. The top 2 lines there actually show the decomposition of large and small cap of our domestic benchmark, the MSCI USA. You can see that US stocks, as everybody knows, if you've looked at a stock chart or a CNBC show or anything over the last couple of years, have really torn it up and have substantially outpaced on a cumulative basis the performance of international stocks, especially over the last, say 5 years. The lower chart, which is the yellow and gray bars, is again breaking down our international benchmark into its large cap and small cap components. Typically, small caps tend to outperform large caps over longer periods of time, and you can see that is the case here, at least on the international side, that yellow bar is quite a bit above the gray bar, again, especially over the past 5 years. On the domestic side, large caps have really been go-go until maybe the last quarter or so. So it's a little bit of a different story there, but over the longer term, even there, small caps have tended to outperform large caps. So again, the idea of this chart is just to kind of give a broad picture of large versus small, domestic versus international, kind of all in one quick shot. Page 10 breaks this down into this is a risk versus return chart. So basically, you're annualizing for the return, which is on the y-axis there. You're just annualizing that entire return stream from the previous page and making a single dot out of it. Standard deviation is probably the most typical way that we define risk in the equity space. how much the stock moves around or how much the index moves around, to put it extremely simply, I guess I would say. So here you can see again, summarizing the return dots for domestic small cap. Has slightly underperformed domestic large cap over that period of time, but they have both pretty widely outperformed the gray and yellow dots again, which represent the international stocks. You can again see here that the gray dot is higher on the y-axis than the yellow dot, indicating the outperformance of small versus large. Typically, what you would see is that the higher the return, the higher the risk, the higher the return. One thing that was kind of surprising me when I was building this chart is the fact that the riskiness of taking risk and return together, even though something like domestic large cap, or international large cap, the yellow dot, is farther to the right than domestic large cap, which is the blue dot. So it's riskier, but actually hasn't quite produced as much return. So why we think that's the case, Randy talked about the impact of international currencies, so that, there's been substantial volatility there. Emerging markets, which as we see represent an increasingly large percentage of the international benchmark, are more volatile as well. And also timeframes matter. This is summarizing 15 years into one entire chart. But if you were to take smaller sections of that, you'd probably see periods where the risk return trade-off is more what you would see, i.e. You'd get better returns out of international stocks relative to the return that relative to the risk that you're taking. But it doesn't always work out that way, which is kind of what you can see here. One other thing to point out is this data is drawn from FactSet, and we are going to have a demo, a live demo. We like to give live demos of how that works, but this is just one small example of a chart that we might output from that. But it's a very useful program to us in all sorts of ways, and so this is just one tiny example of what that might look like. On page 11, some details.
Before you go on,
yeah, go ahead.
Question.
Yeah.
Okay. You look at page 9.
Yep.
And combine that with what you just said about 10. And you look at page 9, and I know that this takes on a long period of time. So within some of these shorter periods of time, there's variations, but over the long period of time, these lines move. Looks like they move fairly similar to one another. And then if you look at 10 and you're taking more risk for less return, I mean, doesn't that raise the question of why we're doing international at all?
I guess I would say that number one, as I mentioned, time frames do matter. Number two, there are reasons other than just pure return that we invest in the international space, and that kind of goes back to what I mentioned before about diversification in terms of countries, in terms of currencies, in terms of sectors, because the international market.
If we get from that diversification on page 9 lines that move similarly, then what good is the diversification?
I guess I would say part of the reason they move similarly is because when we talk about beta, which is, kind of how the market itself moves, equity beta to some extent is going to be similar across whatever kind of public equity you're invested in. So I would say that is probably the primary reason that the shape of the lines is similar, if I can put it that way. So there's a certain, we could decompose this and break out exactly what those betas are. I don't have a chart in here like that, but equities to a certain extent behave like equities. If that's probably the best way I can phrase it. So regardless of whether it's large, small, international, domestic, there's going to be a certain similarity in the shape of the pattern, which I agree that, we do see a similar pattern in that, but there's more to equities than just beta. That's kind of the underlying driver of it all, but we try to, decrease our risk, improve our returns in various ways to the best we can. And one of the ways we do that is by not strictly investing in domestics or not strictly investing in large caps.
I would also, Mr. Chairman, just add a quick comment. There's the short-term diversification and then there's the long-term diversification. Yes, they do move similarly. The correlation between returns has increased. I know it seems like a long time, but the grand scheme of things, 15 years is not that long. And there's also a return element. So US equities have really led for a while, and valuations, and we'll get into this later, have become stretched as a result. It's certainly conceivable that the next 15 years will look very different. And by diversifying into a different section of the equity market, if that happens, you're not going to get hurt as much as if you were just in US equity.
Okay. Thank you.
Thanks, Mark. Appreciate it. So on page 11, this is going to be a little bit of a discussion on the benchmark itself that we use for international. For the asset class as a whole, we use something called MSCI All Country World ex-US Investable Market Index. Now, I will be the first to admit that MSCI is absolutely terrible in their index naming, in their index abbreviations. So here, very briefly, is what that actually means. MSCI is the name of the index provider. All country simply is a shorthand way to indicate that it includes both developed and emerging market countries together. IMI, again, is just a very shorthand way to indicate that it includes stocks from small cap to large cap. It's not specific to one or the other. Now, it is possible to decompose this benchmark pretty much any way you can imagine. And we do in fact use subsets of the broader market, such as small cap dedicated, as appropriate to an individual portfolio. We don't actually have any single manager that invests across the entire market cap spectrum as a mandate. They generally are either large or small or value or growth. And we're going to talk about that a little bit later as well. So when we roll all that stuff up, that's how we measure it at the asset class level to say whether international stocks, broadly speaking, outperformed or underperformed their benchmark. But it's useful to us to be able to measure an individual manager against the subset of the universe that they're investing in. So that's how we use both the master level, high level benchmark, as well as decomposing it into the smaller chunks for relevant uses. A little bit more on page 12. I alluded to this earlier, what happens when they do reviews. So currently MSCI is set up to do fairly major semi-annual index reviews. These occur in November and May. Currently, what sorts of things happen at that time? They add and remove companies from the indexes. They assign country classifications for any new stocks coming in. An important one is that they recalculate the numerical market cap breakpoint between large and small cap. As I alluded to, they do typically at this point implement any previously announced country reclassifications, which most often involves moving from emerging to developed markets. And those typically will occur in conjunction with these semi-annual reviews. In the off quarters, MSCI conducts less comprehensive quarterly index reviews. They'll do things like possibly include recent IPOs into the index and things of that nature, but they don't recalculate the large cap versus small cap breakpoints at that time. So they don't want to let it go too long without doing what's necessary to have an index that's representative as best they can of the entire equity universe. But at the same time, they don't want to completely overhaul it nonstop because, that would be difficult for index managers and frankly, active managers to keep up with. So that's the way that it's currently constructed. They're always thinking about whether they want to tweak those things, and you know, that's something that they're thinking about all the time. But at this point in time, that's the way it's constructed and set up. And finally, for me at this point on page 13, this has become relevant recently. So they do big semi-annual reviews, they do lesser quarterly reviews, but they absolutely reserve the right to conduct index changes as appropriate outside of those semi-annual and quarterly reviews. An important one recently here is the decision to exclude companies that the US government has identified as having ties to the Chinese military. Being as how that was kind of a mandate coming down from on high, if you will, MSCI found it important to get on that sooner rather than later. So basically, anytime the government puts out a new list of names to exclude, the benchmark provider will say, okay, as of January 21st or whatever date they pick, we're going to remove those from our index. Now we have a couple of index managers that replicate the benchmark holdings. BlackRock is our biggest one, and frankly, on the international side is our only one. So they attempt to replicate those benchmark holdings as best they can. They're attempting just strictly to create beta, not alpha. And so they have been very good about matching whatever changes that the index providers have announced in terms of kicking out these Chinese military names. And I would point out as an aside, but an important one, to the extent that we have any active managers, that is to say non-index fund managers that have held any of those names, they've kicked them out on a timely basis as well.
Are they under a mandate to do so, or do they just do that because they're no longer part of the index?
They do it because it's no longer part of the index, because their goal is, again, just to replicate the benchmark. So they can capture whatever the equity beta is, and that's the mandate that index fund managers have, is to replicate the benchmark. It's not to.
Yeah, but what about with the active managers?
The active managers have done it on their own. We could go to them and say, you know, it's harder for us to do it with something like an index fund, especially if it's a commingled fund, because we don't control the underlying holdings. But with our active managers, in the vast majority of cases, they're separately managed accounts. So we actually own the underlying stocks directly. State Street custodies those. So if we wanted to, we could go to the manager and say, hey, you got to get rid of XYZ. But the managers, and we've only had one or two that had any of those stocks, have been very proactive about it, probably because they know they're going to get rained on anyway, so they might as well just take care of it. So barring any other questions, I will hand it off to Jason.
Thanks, Dave. Mr. Chairman, members of the board, I'm on page 14. I'll discuss a few of the aspects of the structure of the international equities asset class. First, the asset class is well diversified by sector and by region. Steve discussed the fact that we have both developed markets and emerging markets, as well as by investment strategy, and that would include what we call core managers, as well as value and growth managers. We manage the asset class with a focus on being cost effective. That means blending index portfolios as well as actively managed portfolios. So if we look at large caps has a heavier exposure to index portfolios. About half of our large cap exposure is indexed. Within small caps, the allocation can be managed independently of our large cap allocation. We can do that through ETFs. We can do that through modifying the allocation to our existing active managers. And we do have a heavier exposure to actively managed portfolios in small caps, again, based on our belief that one, they tend to be less efficient. Two, they tend to outperform large caps over time. Again, emerging markets exposure within the asset class, and cash is limited per the investment policy statement of the asset class, as well
as the investment guidelines that we have with each individual manager. Page 15, three types of portfolios within the asset class. Index portfolios, actively managed, and exchange traded funds or ETFs. So our index portfolios are all through commingled funds. That's where we are an investor with in a fund with other institutional investors. Actively managed portfolios include a combination of separate accounts where we are the only investor in that account, as well as commingled funds. And we have both fundamental and quantitative, or you might call them systematic methodologies. So you think of fundamental as your traditional stock picking strategy with a team of analysts that's researching individual stocks and making recommendations to a portfolio manager who then decides what stocks to buy and sell. And you compare that with a quantitative methodology where the manager uses a systematic process using mathematical or statistical factors that are then optimized and blended together to decide which stocks to buy and sell. That's not to say that quantitative managers aren't fundamental. A lot of their factors are indeed rooted in valuation, quality, and growth, basically fundamental factors that any other type of stock manager would use, but shows you a little bit of difference between the process as opposed to completely different philosophies. And lastly, exchange traded funds, which is a low cost way to access certain areas of the market, for instance, as we do with emerging markets.
Could I get a little refresher on exchange traded funds, please?
So as opposed to, so the exchange traded fund would be mimicking an index, and it trades on exchange just like a stock. That's the basic idea of exchange traded funds. So it's low cost, high liquidity.
Okay, thank you.
Page 16 shows the types of portfolios indexed. You see that, as Steve mentioned, that our ETFs and our index portfolios are with BlackRock. And then on the bottom of the page, the actively managed portfolios broken down by quant and by fundamental strategies. And page 17 shows the different types of investment styles broken down by value and core and growth, and where the different managers that fall within those different areas. Page 18, so the asset class is constructed with complementary actively managed portfolios. That includes styles, like I mentioned, the core managers, growth and value, different methodologies, fundamental and quantitative, market capture profiles. So we talk of upside capture and downside capture. So the upside capture would be how much a portfolio increases in value when the markets are up, and a downside capture would measure how much a portfolio goes down when the market is down. And we have different types of managers based on, some are more upside market capture focused, some more downside market capture focused. And blending these all together helps reduce overlap and obtain low correlation of returns among portfolios, so to better benefit and capture the benefits of diversification within the asset class. We typically have a overweight to small caps based on, again, they tend to be less efficient and tend to outperform large caps. Within emerging markets, we can adjust the emerging market allocation with ETFs. And again, the cash is limited per policy and at the investment guidelines that we have with each manager. Page 19 shows the breakdown by market cap segment and the managers within there, and as well as by allocation to each manager and the percent they make of the entire asset class. Any questions there? Otherwise, we'll turn it back to Steve, who will discuss due diligence and monitoring.
All right, so I'm back. We have manager evaluation policies that kind of guide what we look at in terms of managers and how we go about doing it. Very briefly, we have one of the most important things we do is the quarterly review process, in which we use FactSet to do attribution of the manager's performance, so we can break down how they did and why. That allows us to ask informed questions of them when we have a call with them each quarter, and then subsequent to that, we write up a couple of page summary of what we talked about them with them, so that there's a paper trail of what we've done with them. And we also create the manager scorecard, which Dan, did everybody get that handed out? Do you know?
Yes, it was on everybody's desk this morning.
All right, great. So hopefully you either have a hard copy or electronically. This is an anonymized version of one of our manager scorecards from last quarter. We don't want to give out the secret sauce, but we've mentioned this scorecard a number of times, and so we wanted to show you what does it actually look like. There's basically drawn from the policy 11 areas or so here that we look at and kind of qualitatively rank a minus or a neutral or plus in each category, and update that each quarter. For anything there, especially anything that's not a plus, we might want to make some brief notes down below as to why we rated them in such a way. So here you can see there were some minor PM team changes that didn't have too much direct impact on our portfolio, but we wanted to make note of them just the same. Underperformance in this case, I didn't want to say why that was, because it would probably tend to reveal who the manager was, but it was a neutral there as well. The other half of this, if you look at the second page of the scorecard, is a chronology. So again, we keep track of important things that have happened in the history of the firm, important personnel changes, when we visited them, when they visited us in person, things of that nature. So it's just kind of, I guess if you as a new person coming in, needed to find out what makes this manager tick in a very, kind of summary way, this is a place that you could to come in and look at that. And like I say, we do update this every single quarter, such that there's an ongoing paper trail, and you can look at it from one quarter to the next and kind of see if there's an improvement in the rating over time, a degradation in the rating over time. And that would, I probably should have mentioned this back on the front page. Ultimately, we do have either a retain or a terminate rating for each manager each quarter. So just wanted to make sure you guys actually saw that, because we've mentioned it about 5,000 times, and wanted to make sure that you saw it. One thing that I would point out of the 11 characteristics we look at here, one of them is performance. Performance obviously is important, but unlike some asset managers that are out there, or pension funds or whatnot, we don't have an automatic terminate if you've got like a -3 or relative number or things like that. We're not chasing the short term. We're investing for the long term, and hopefully, you can see that we have a process in place where we actually live by that.
Bruce.
Yeah, question. Has the pandemic affected your due diligence or monitoring any?
It has obviously prevented us in many cases from being able to visit a manager in person, and them from coming to visit us. But we have continued to do, probably in some cases, more Zoom calls and things of that nature than we would have done in the past. So we've tried to make up for it. In the long run, is it ideal? No, but we have a plan for getting back to doing those kinds of reviews. And one of the things that we talk about here is on-site visits. And we actually have kind of an informal schedule where we try to make sure that we go to visit each one of these managers every certain number of years or whatever. So under normal circumstances, we would do that. That's been a little bit suspended right now. It's a fair question. So basically we've just tried to make up for it with more calls, but in the long run, we have every intention of getting back to the in-persons.
Thanks.
Yep.
Is the recommendation a recommendation for the quarter, or is that like a cumulative recommendation?
I would say that it's a cumulative recommendation. I mean, it's possible that something happened in one quarter that was so bad that, you know, we had to get rid of somebody immediately, but it really is, you know, I don't want to beat the dead horse, but when we say we invest for the long term, that part of what that incorporates is understanding the trends over the long term. So at some point, would there get to be a point where, you know, we update the scorecard every quarter. So yeah, there would be some quarter that it got to the point where we said, okay, this, you know, we're changing the recommendation on this, but that shouldn't come as a surprise to anybody on the public markets team when we get to that point, because we've been having discussions about it, and whoever the lead analyst is for a given manager would probably be, you know, kind of giving some clues or some comments to the effect of, you know, I'm becoming less comfortable with this manager because of such and such reason.
And is this the lead analyst or the team's recommendation?
The lead analyst would write the scorecard, but everybody's on the calls when we do the quarterly calls with the manager. So anybody can, you know, pose questions to them. Anybody can raise issues that we might want to follow up on, but ultimately this page that you see in front of you here is the product of whoever the lead analyst is in the final analysis.
And then Randy, maybe this is a question for you. What happened then? You end up with a recommendation from your lead analyst not to not return, or to retain someone who you've got your doubts about, or not retain someone who you have confidence in. Then what happens?
Yeah, at the end of the day, Carl, it's basically my decision on whether we go forward with a termination or not. So I take the recommendation from the analyst, and like Steve said, there's so far to date, hasn't been any surprises like, wow, you want to terminate these guys, or you want to retain these guys. We're, you know, because we attend the quarterly reviews and we talk about the managers and the reviews afterwards and such. To date anyway, there has not been any surprises there. The only difference has been maybe in the timing of some moves that we've made. And like I said, that's more of a decision that I come up with on, you know, based on, you know, do we give these guys a little bit longer to get their act together, or, you know, how difficult is the situation that's developed with the company? What alternatives we have for different managers to move to, those type of things.
And just from a real high level, do you do the same thing in domestic?
Yes.
Okay, that's what I assumed, but.
Yeah, this entire due diligence and monitoring process we're talking about here goes, you know, with domestic equities as well as high yield for that matter.
Done. And I'm going to display my ignorance here, but is this process outlined in writing anywhere?
The external manager evaluation policy is a policy that has been written that this basically follows, yes.
Is it a staff policy or board policy, Villa?
The evaluation,
Yeah,
staff,
okay,
that's part of the delegated authority.
okay. It's nice to see the
Carl, I
score.
have a question.
Yes,
So can you guys give me an example of something that might be so egregious that you terminate somebody relatively quickly?
Yeah, we've actually had one of those in history. There was a case where this was a quantitative manager that we had, where it turned out that basically there were some errors in the model that they were hiding. And when it came out, so I mean, they probably weren't such egregious errors that it, you know, destroyed the process or something, but still, you know, that's not okay for you as the manager to know that this is going on and, you know, not reveal it. So that was a case where it was, I don't know if it was the next day, but it was pretty close. Yeah. So it would have to be, yeah, something that's outright deceitful or something like that, or, you know. So it'd have to be pretty severe. Other than that, you know, we track things over a period of time, but it can happen. Fortunately, not very often, but.
Another case might be a team lift out. So
Yeah.
the team is managing a strategy and gets up and leaves and either starts their own firm or joins somebody else and leaves behind the product, but nobody else to manage it, or a new team to manage that we haven't had experience with.
Yeah, we've actually had one of those too. It wasn't quite the next day, but we did have some conversations with the new team that took over, but it still was not a comfort level.
So how do you get notified of these things? I mean, I'm just curious.
It's, we try very hard and we beat the managers over the head with this kind of stuff, that when you become aware of something, you should tell us. So in the earlier example I gave you, it was the guy that was actually running the model that knew it, but he was kind of keeping it a secret, I guess I would say, from the rest of the team. So as soon as the rest of the team became aware of it, they, you know, contacted us. So ideally, it's the manager contacts us. If it's something that we read about in the news before we hear about it from the manager, we're not happy about that.
Might you have somebody who's exiting with that team, in Jason's example, contact you saying, hey, you know, 10 of us are leaving here, there's nothing left.
Yeah, I'm trying to think what the timing was on that.
How on the team then.
Yeah.
But no, best practices, we hear it from the manager before we read about it in the press.
Yeah, Randy, do you remember what the
I'm not
was on
exactly
the
sure.
Pelican one?
I'm not exactly sure what the days and weeks were, but it was a portfolio manager left, and he took a couple people with him to a new firm. And then a little while later, might have been another 3 weeks or 4 weeks or whatever, then another team member or two left the manager we were with and went to that new manager that we were not under contract with. So it was kind of like a, you know, the writing was on the wall, so to speak, but it wasn't all of an immediate lift out, but it was pretty obvious that it was, you know, a lift out in progress. So we did exit that manager.
Thank you.
Another thing to keep in mind too on this is that we're not the only ones looking at this type of information out there with our managers, because you know, RVK is they're looking at these managers typically too. So you know, there's times when you know, things will happen, and RVK is on top of it as well, and will, you know, give us their opinion on what they think about, say, that lift out or the improprieties with that quant model, those type of things.
That leads into my question, which is the RVK, or are we following best practices on this monitoring?
Well, I would have to say two things, and Becky or Mark may chime in, but one, your group, and it's appropriate given that your staff has substantial delegation, has more tools. You've provided them with more tools than the average public fund staff by a wide margin, number one. Number two is that the regularity with which they're in contact with managers is substantial, and that would represent best practice. And they do confer with us, and we communicate proactively with them, keeping in mind that we work for the board, but we support the staff on a regular basis. Becky, did you have anything you wanted to add to that?
I was just going to add that in the case of the model mistake that was covered up, I recall us proactively calling and contacting the Bureau just to let you know that what we had heard, what our assessment was, make our recommendation, and that's very common. There's a lot of movement sometimes with these managers in personnel from time to time, and these model-related errors are much more rare, but important to address the trust that you have with managers. In that particular one, the manager broke that trust. So we like the monitoring system that the Bureau has in place, do think it's best practices. And I'd say, if anything, the type of Zoom calls and other types of video conferencing, even when things are quote unquote, back to normal, this has given a new tool for the Bureau and for a lot of investors to continue that really in-depth dialogue with managers, even in between on-site visits and telephone calls. So we're happy with the process that the Bureau follows.
Yeah, just one quick, at the end of the day, you never know for sure whether you got a good manager. I know it's hard to accept that, but it is really, you probably know at this point, it's very hard to find managers that have a durable competitive advantage to beat markets that are often pretty efficient. And, the tools that you're using try to increase those odds, and, you've had success, particularly in international equity, in doing that. There are other areas where it has become so hard that, and you've done this with the domestic equity portfolio, when you've had managers that are underperforming, the question becomes, is this just this manager, or is this the entire asset class? And if the answer is the entire asset class, you go more to passive, and you've done that. So, at the end of the day, you're doing the right things. It's not a perfect process. You're going to hire managers that it turns out in retrospect, they did not have sufficient talent to outperform the market. If you can get it 70% right, you're going to do very well, and do as much as you can to identify those managers that either have lost their competitive advantage or appear to have it but never really did. And then make a decision whether this is endemic of the entire asset class, therefore we should go to passive, or there is another opportunity out there where we're sufficiently confident.
Yeah, I would also add that, there's a lot of patience and a lot of discipline that goes into this, because things ebb and flow in the markets, and managers' performance can go out of favor for only the reason that they're out of favor, rather than that, there's something broken. And so there's a lot of, like I said, takes a lot of patience to see through those times, and not throw your hands up in the air and fire a manager and move to a new one when you may already have a good one and you feel that you do.
Could I ask Randy about the bench? Is there, how big is the bench? I don't need names or anything, but do you feel comfortable that if you had to change, the bench is available to you?
Largely, yes, I would say so. We typically have anywhere from 2 to 4 managers in the different respective areas that we consider our bench players, you might say. We stay in contact with them to some extent, not as much as we do with our managers we have under contract because of the time involved, but we do feel that we know managers out there that, if we did have to do something very quickly, a quick exit or something, that, we have those managers there on our bench. And then also, we have ETFs and index funds as well. So, if something happens in the case where a manager needs to be terminated, in a day or something like that, we have passive funds that those assets can be moved to.
Maybe just to quickly add, I think we all learned from December of 2018 that we now have a better communication process that's not necessarily articulated in policy, but when the CIO makes the determination that it's time to move on something like this, we're going to get that to the board sooner rather than later. Same aspect of what Jason and Steve and Randy said. If we read it in the paper, we're going to be upset. Well, same thing goes for us to you, that if you see something happening, you're going to hear about it from us first. So as soon as John starts to bring to me, hey, we've got this problem with manager X, Y, or Z, as we get closer toward some sort of termination under our new processes, you all will be made aware of that before or shortly after not before, but shortly after John and Randy pull the trigger.
So following up on something Becky said, and I don't know if this goes to the whole staff. I don't know, Randy, if this is yours or Dan Villa or Jason or Steven. Have you guys do you have in your mind an idea of how this looks when you are able to travel again and how much you will use some of the technology that you've had to use during COVID?
I guess I'll take a stab at that first, Carl. The way we've been working with our managers, 90% of our quarterly reviews are done on Zoom now, as opposed to, you know, the simple conference calls we had before. And my sense is from our managers that that's going to continue. So in that respect, that's what we're expecting. And then as far as the travel, I mean, there will be a time when, you know, we can travel again, and we do have we keep track of a schedule of what managers we have not seen as recently as others. And so we do have those in mind to go see first, for instance.
So Carl, maybe one thing to add to that, this is not only within this portfolio, but across all of our managers. Once we start to open up, not only we as BOI in the state of Montana, but the managers themselves, we need to get our CIO out there. He was hired 3 weeks before the entire country went on lockdown. So in order to build the relationships that we need across all of our asset classes, we're looking at pre-planning travel a year out for, okay, who are the managers we need to go visit in New York this year? And we send a whole team to go hit that geographic destination. We look at California, we look at Florida, and we start looking at geographies to hit not only those within international equities, but our entire stable, and get out and start touching base with those folks again, but also leave ourselves the wiggle room that if something comes up and we need to get there immediately, we can put folks in front of our managers or get them in here relatively quickly for if there's a problem. But we've got to I think we're going to have a different travel structure than we did before of sort of one-offs, and we're going to start coinciding multiple teams to geographic areas to touch managers on a more regular basis, but then leave ourselves the wiggle room for not only due diligence as necessary, but the bigger problem when something comes up, they're either coming here or we're going there right away.
And briefly, I take it you think that the Zoom quarterly calls are better than the phone calls. Why?
Well, I guess that's for me, Carl. Well, it's the same thing as meeting person in person, only, you're not quite person in person, but, you still can basically look somebody in the eye on a video and talk to them, see their body language and those type of things when, they answer the questions that you throw at them. So it's not as good as sitting down in person, but it's definitely better than, on just looking at the squawk box when you're talking to somebody.
I think we're
Another thing I should mention is not just our travel to the managers, but the managers do come and see us, and they haven't been able to do that for the last year plus either. So they've been on hold, and their companies have been keeping them on hold, as well as we've been keeping them on hold. Some of them have volunteered to come see us already. So that will pick up too, probably, I would think probably later in the year, September, or, fall or early fall or late fall.
And I think we're having those conversations with our managers now, Carl, as we go through we're kind of in the midst of, or starting, I guess, the quarterly call process, at least in public markets. So we're asking all of them, and you get a variety of answers as to, some of them that are kind of on the same pace that we are, that maybe you're going to think about opening up in July or August or what have you, and some that have already punted being open, and in the office until 2022. So, it will depend a lot on kind of, we have to be able to go to their office in order for that visit to work. And I'm not sure that's going to be uniform, at least at the end of this year. We'll see.
Thank you.
Appreciate all the questions. I guess the last thing for me is I do want to share with you guys the FactSet demo. So I'm going to screen share. You folks that are on Zoom are probably actually going to benefit from this because you'll be able to see it kind of close up. The folks in the room here might be a little small, but we'll do the best we can. Okay. So we talk about FactSet a lot, so I've just preloaded some screens here, so hopefully everybody can see it. Basically, what this does is it takes the holdings that are fed by the custodian every day and breaks it down into sector or country or market cap or whatever it is that we want to look at it from. So here I've just kind of got the standard sector breakdown. I'm using Bailey Gifford, which is one of our international large cap managers, as an example here. So this is a little small, but you can kind of see, for example, communication services, you can see on the top line there that I've got highlighted, was kind of a weaker area for them. Whereas down here at the bottom, healthcare was a pretty strong area for them. And if I want to drill down deeper on that, I can just hit the plus sign here, and then I can look at individual industry level. And then if I want to drill down one more level still, I can look at individual companies. So what we would do is we would, as I said, we run this in advance for all of our managers ahead of the conference calls or Zooms that we do each quarter. Print out some of these charts for distribution to the rest of the public markets team, and come up with hopefully intelligent questions to ask the managers. So, you know, if there was a sector or a stock that did particularly well or bad, we can ask them, you know, hey, we noticed this, you know, what's your explanation for that? So this is a breakdown by by sector. Here we have a breakdown by country, where actually first we have it broken down into, we separate it by developed. And if I scroll down here, can't find my scroll bar, so you're just gonna take my word for it. If you went down farther, you'd see the emerging market stocks. So same kind of a thing here, you know, if I want to see, okay, what happened in Australia, I can look at it and I can see, okay, this Cochlear Limited, which, you know, from prior discussions and by the name of it, you can tell is kind of an ear implant company, did pretty well. Xero, and if I want to find out what they do, I can right click on it, bring up the company guide and say, I don't have a clue what Xero does. Let's find out what they do. Okay, online business solutions for businesses. Now, cloud-based accounting software. Okay, so that's pretty big these days, cloud-based computing. So, so just in an instant, if there's a company that you don't know anything about, you can get a thumbnail sketch of them. We can break it down by market cap instead of quarter or instead of sector or industry. If I want to break out just the individual stock performance and say, okay, what were the best and worst individual stock performers as opposed to the sector level, I can break it down here. So it ranks them top. And again, if I were able to scroll down here, you'd see that the bottom performers are down there too. So if there's something that really was an outsized good or bad performer compared to everything else, it's apparent in an instant, and then you've got an intelligent question to ask about right off the bat. Characteristics, if we want to break down, these are some statistics that are similar to the index breakdown that I showed you earlier, where it's got price to book and PE and market cap and all that kind of stuff. So we can say, okay, this is a growth manager. It's yielding less than the benchmark. That's not surprising for a growth manager, to be honest. It's trading at a slight, or its projected EPS growth is a little bit better than the benchmark. PE here, it's trading at a premium to the benchmark, but since it has better growth than the benchmark, that's probably appropriate. Things of that nature, so you can just kind of eyeball it and say, hey, is there anything that really sticks out here and that inspires a question? Here I can find my scroll bar, fortunately. Turnover. So this manager is a fairly high conviction, low turnover manager. So you can see that here. There's a couple of quarters where they have, you know, turnover in the 7%, but most of the time it's in the 3% range. As I say, they're a very high conviction manager, and this is kind of proof of that. You know, if somebody claimed to be a high conviction manager but turned the portfolio over all the time, you probably would have a conversation with them about that, or, you know, that might be the kind of thing that led you toward the termination conversation. Let's see here. Active share is a good one to show. Basically, this is kind of basically how different is it from the benchmark? Are they actually taking a stand on things? Are they holding different stocks than the benchmark? Are they holding the same stocks but in different proportions? We internally kind of view the 80% level as kind of a minimum for a true active share manager. You can see for the most part, they've been above that. You can see the last year or so, they've been a little bit low. That's probably a function of higher volatility in the market causing them to take a little bit less risk. Change in weights. So again, we can see from one quarter to the next or 1 year to the next or what have you, where they've been buying and selling. So we can see here, consumer discretionary, materials, financials are areas that they've been adding to the portfolio. Comm services, tech, staples, places like that are places that they've been subtracting from the portfolio. Typically towards the end of a conference call, we ask, you know, the managers, what's your positioning and where do you see yourselves going forward? So if they said, you know, we're finding more ideas in such and such sector, and then the next sector comes around and it turns out they actually sold down that sector, you know, again, there's something that you can ask them about. How come you did the opposite of what you know, thought was going to be the case? And, you know, hopefully that's for good reasons and not just that something blew up in the portfolio, but it's, you know, it is what it is. So I am going to switch over to SPAR, which we tend to use this, at least I do, a little bit more for prospective manager searching as opposed to existing manager analysis. We talk about bench building. I've recently been doing some work in domestic small cap. So what you see here is a selection of kind of a random selection of small cap managers in that space. So on this front page here, basically you can just kind of quickly get a sense of you know, how their returns have done. This purple line here is Jennison, obviously. They had a particularly good 2020. This darker blue line here is a State Street fund, obviously didn't have quite as good of a year. So that's just, you know, one quick one, multi-horizon. So that's based on calendar year. A lot of times it's useful to see trailing year. So here we can see trailing 1 year, 3 year, 5 year, however far out you want to see that. So you can see the longer term trends. Are there guys that are starting to stand out or not stand out? One of the things that Jason alluded to is this idea that we like to have managers that have different return patterns, low correlation of returns. So this module actually has a program that does exactly that. So we can see, for example, that State Street that we just looked at that had poor performance. We see it actually has negative correlation with this BMP portfolio right here, this negative 0.46 down here in the corner. So portfolios that actually have negative correlation to each other might be a good match in terms of, as we mentioned, you know, some managers are going to do better in up markets, some are going to do better in down markets. This is the kind of chart that helps you to ferret that kind of correlation out. We can also use this to look at statistics like standard deviation. Tracking error is one that we look at quite a bit when we're doing manager searches. This chart unfortunately kind of collapsed on itself, so there's not much to see, but you can see the numbers down here. We can see that Principal had fairly low tracking error. Jennison and Neuberger were a little bit on the higher end. Up, down. So this is a graphical illustration of what up market versus down market capture might look at. This sector or this quadrant down here, to me, represents more or less downside capture managers. So we can see here that this Fidelity and this principal are fairly downside. This quadrant over here in the lower right that's kind of running off the screen, that's no man's land to me. That's you're giving up too much in down markets and you're not keeping up in the up markets either. So it's only one data point, but generally a stock that you found down here in the lower right-hand corner is probably not the best investment. I kind of like to look at ones that are up here in the upper left. These tend to be a little bit more all-season managers, which is to say they do relatively well in up markets and manage to hold on to it in down markets. So when we talk about up market versus down market, that's an actual graphical illustration of what that looks like. And finally, we can also compare, and again, this chart squashed, I feel bad about that, but you can see there's kind of 4 blue colored bars here. So that breaks not just these 6 managers, but the entire small cap universe, which in this case, that's small cap core. So here it's, I think it was like 109 names or something. So how do these individual managers sit for each characteristic, whether that's return or risk or whatnot? How do they sit within the entire universe? Are they typically above median manager? Are they typically below median manager? And let's see. I guess I'm going to show one more thing, which is rolling style chart. So this is a little bit busy because it's got 6 managers dropped in it, but basically each color dot here represents one particular manager, and you can kind of see, so they're all below this middle line here. So you can see they definitely are small managers. Some of them tend to lean a little bit more in value. You can see these darker blue ones is the State Street one, or a little bit more over here toward the value. This purple one here, which is Jennison, tends to be a little bit more over here on the right side. This dark green one here, which is, oh, that's actually the benchmark. Okay. These yellowish ones here tend to be a little bit closer to center, so it's probably more of a true core manager. If you're looking at this for an individual manager as opposed to a group of them, one of the things you can tell from this chart is something we call style drift, which is if the circles don't all stay in one quadrant and all of a sudden they start drifting up here, then it's potential indication that your manager isn't sticking to the style basis that you hired them on. And so, that could be a result of hiring a new PM, or they just have kind of started to chase performance or whatnot. So that's another thing that you can do with this chart. But this is just a real small sample of the things that FactSet can do. I mean, you can look at individual stock performance, you can do research on stocks, you can look at market news, but these are the kind of high level things that we do with it. And my final comment would be is it's a very useful program.
How much does it cost?
Does anybody know that one? Or want to answer that one?
It ain't cheap.
But I mean, it's worth it probably, but.
This is one of those things like Bloomberg that we just can't replace at this time.
Yeah.
We don't have an alternative.
I concur. So please don't take it away. You might as well take me away.
Well, maybe this will take you away. Steve is the FactSet expert. No 2 ways about it.
I appreciate it.
All right.
Well,
Is
back
that
to
it,
Jason, he's got a
Randy?
couple more pages.
Stop sharing them all.
Oh yeah, I gotta kill the sharing. That's right, I forgot. I even had a note to myself to do that and I still forgot. Okay.
Where are we, folks?
All right, so back to the presentation. This is on page 21. We discussed a little bit, had some questions about terminating managers. So when is the time to terminate a manager? So the process we use, as you see in the scorecard, combines qualitative and quantitative factors. But the process is not a formulaic one. It's one that we rely heavily on professional judgment and experience to analyze a manager and to determine if we should retain or terminate the manager. And we talked a lot about performance. Performance really is rarely the only reason for termination. That to understand a manager, you have to understand the market context, that the manager's strategy, over that period of time, to understand the dynamics that were going on in the market. And there are times when a style might be out of favor, and during that time, we might be surprised if they outperformed during that time period. And while managers do have ups and downs, again, short-term performance is rarely a good indication of a manager's skill. It's more just that would be considered noise. Some of the red flags we talked about, reasons for terminating, first would be firm instability, a change of ownership, or excessive staff turnover. We talked about the most extreme case of a team lift out where an entire team leaves and either starts their own firm or joins another firm, or change of leadership, legal or regulatory problems. Other reasons might be an ethical breach or loss of trust. We talked about in a case of that. Steve mentioned style drift, which really is when a manager diverges from the portfolio's stated objective or style. Basically, the manager is doing something that we would not expect them to do. Or other reasons would be inadequate risk controls, or serious client service issues, or a combination of any of these that we discussed. Any questions there? I will now show you a little bit about another tool that we use, which is eVestment. And eVestment really is the gold standard for databases of public markets managers. We can use this for existing managers, although FactSet's something that we really lean more heavily on for that. But we can also use it for identifying prospective managers if we're doing a search in a particular strategy. And I think that's really where it benefits. And the two, eVestment and FactSet, definitely complement each other well, given their different strengths. So the first thing I might do is look at the screening function. This would be something we would do when we're looking for a new manager. And I can set the parameters for a search. And you see the over 18,000 products within the database. And we're looking for a subset of this. And as opposed to going through how it shows all these things, what are the things I might look for? We might screen on asset information, say minimum asset levels for the firm or the strategy to make sure they have a critical mass to be able to implement the strategy. We can also look for the institutional assets they might have to make sure that the manager is well equipped to deal with an institutional client like ourselves. Returns data, I can look at calendar year returns or trailing year return or trailing returns over a number of different time horizons. And other things we might look for, volatility metrics or risk-adjusted return metrics. And so what that might look like, and this is a simple example, would be an output that looks like a spreadsheet like this. I don't know how we can see that. That then, out of the 18,000 in this area that we searched for, here are 20-some managers that show up. And I've included here asset levels, returns data, tracking error, which is look at how different the returns are of a manager's history versus the benchmark, and an information ratio is consider that a risk-adjusted return type of metric. And I can sort these quickly. But really, this is used as a starting point in terms of a search, and something we might do, say we get further down the road with a manager, is to ask them for their return history and holdings data, which we can then plug into FactSet to dig deeper into that manager's history. Something else we can use to be able to compare managers is to chart. So I did a screen and it showed up 20-some managers, and I just used one metric here. It's a trailing 5-year returns, and which has a graph, a chart that shows the peer ranking within the universe by quartile of the different managers on their 5-year returns. And this is obviously this is busy. I can click off managers if I want to make it a little easier to read. But it's a useful tool when I'm looking at a screen to be able to look at a number of different metrics that on a chart to better understand where a manager places in the universe. The other thing I'll show, and like I said, there are a lot of things eVestment can do, but the charting, the screening, and I use the profiles a lot for looking at our existing managers as well as prospects. And basically, this is some canned reports and charts of returns data, and which is easily accessed to some of these things that we might do elsewhere in the charting function. But peer analysis is one thing we look at. So first you look at a manager's absolute returns, the relative returns versus the benchmark. And then last, you might want to look at their returns compared to the other managers in their peer group. And here is Bailey Gifford, one of Steve's managers that he mentioned that we talked about in FactSet. And the other thing I can do from here, outside of just looking at the charts, are the profiles. And this is pretty handy. Typically, say when I'm traveling, I might look at a manager's profile either for a prospect or an existing manager. The full profile of the strategy has description of the firm, assets, has narratives describing the product strategy, a whole host of information that, as well as performance data, that I can download or print out and read on the flight out to better acquaint myself with that manager. So that's just a few things that we use eVestment for. But like I said, it's a good complement with FactSet. It's very strong in looking for screening for new managers, but there are some other things too, like comparing a manager versus its peer group and ranking that's something that we can do with an existing manager that FactSet we probably wouldn't use that for.
So Jason, does that profile kind of tie with Steve's profile that is showing up? You have a profile or description on there? On Steve's, the one you were just talking about, your open
For the
profile.
manager,
Hmm?
for the individual managers.
Is it the same
So
type of
does
thing
Bailey
then, is that-
Gifford come up with the same language that for FactSet as it does in eVestment?
Yeah.
Yes.
Interesting.
Although I think eVestment would be a little deeper probably. correct?
Yeah, it's got eVest is good on narrative, really good on narrative stuff.
There might be, one case might be a small difference in returns. Say if we have an existing manager with a separate account that's included in their composite of similarly managed strategies, that might be a little bit different, maybe because we have different investment guidelines or something, but usually those would be very small differences. But so when I look on eVestment, I'm looking at the composite that they have and the rules for constructing a composite. So, but no, this is very handy, like I said, when traveling, to be able to print it off and stick it in the bag and read on the flight out to, like I said, with either prospects or existing managers.
Mr. Chair, this is Diane. May I ask a couple of questions, please?
Yeah, we're about at the end of this, but.
All right, I'll be fast. This is to, how long have we used FactSet and eVestments? And also RVK, are these the typical best in market tools that you see for boards or investment pools of our size?
We've used FactSet since probably about 06. We actually took on FactSet when we still had the internal equity fund. Probably about a year before we went to using it for external managers instead. So long time.
And eVestment we've used for about 4 years. Back when I was previously on the public markets team, we had just hired 25, 30 managers. And at that time, any search had to go through an RFP process. So there wasn't really anything we could do to on our own to do a search for managers. But it's something that we've added more recently, and it's very valuable.
And to
And
answer your
RVK?
question, yes, thank you, Carl. The answer is that these are industry standard tools, widespread use. RVK uses them themselves. We've vetted other tools and we have preferred these. So your staff is using top of the line tools.
Okay. Anything else, guys? I'm trying to keep us close to on track here. I don't want to cut anybody off, but I know Mark Barry's leaving a little early, so I want to make sure we get deep into the RVK presentation before he has to go. So Randy, anything else?
I guess we could just sum it up fairly quickly there, Jason, if you would. The returns of the pool and the fees kind of speak for themselves there. And Jason, maybe you can just kind of sum up there from that slide.
Yeah, I'll be real quick. Here, page 22, back to the presentation, you see the performance history, as Randy mentioned. Page 23, a recent history of the management fees broken down by year and by market cap and by active and passive, which would be indexed. And you see here the summary. I think the key takeaways, it's the second largest asset class in the pool, well diversified. We mentioned all the different ways we have diversification within the asset class, cost-effective management. We talked about some of the similarities with U.S. stocks in terms of liquidity and volatility. And some of the differences with the main one being foreign currency, which can add to volatility and something that U.S. dollar or U.S. stocks aren't affected by primarily. And I guess last we talked about a due diligence process, how we look at existing managers. We talked about the scorecard, and as well as how we think about how we look for prospects. And we showed you some of the tools with eVestment and FactSet, what we use in the due diligence process, as well as more about our philosophy with how we think about retaining or terminating managers. So that sums it up. Any questions?
Questions? If not, shall we, let's break till 3?
Okay.
And come back then? Does that work for everybody?
Yep. Thank you.
Okay, we'll see you in 9 minutes.
In as many pieces as you can expect from us.
Okay. Is
I
everyone
might
back?
note, I noticed Carl kind of falling asleep there.
I wasn't falling asleep. Many Christmas. Are we back and recording and ready to go?
Yep.
Okay, well, if I could just follow up that last one, because I think when we do these deep dives, I think it's pretty important that, and hopefully, this is a very short answer. I got my fingers crossed it's a short answer, but RVK, after hearing that, is there anything that we're doing that we shouldn't be doing or not doing that we should be doing?
Becky, you want to take that?
Well, from a diligence practice perspective, using tools like eVestment and FactSet have become even more important because there are so many managers in the universe to consider. And eVestment is a really important part of our process as well. So having these quantitatively oriented tools that allow you to search databases and see how your managers actually stack up, and then using tools like FactSet to be able to analyze them are really important. But I think overall your process frequency is good in analyzing managers. In doing the deep dive on structure, it's always a good idea to look at the arrangement of active versus passive. You've got tools to allow the staff to be flexible, for example, in their emerging market allocation, having that ETF tool to help there. So I think that the thing that will be interesting to watch is as the economy starts opening up and that travel does start again for your team, is just finding the right way to get that started in a way that's sustainable. We find that other clients having a due diligence travel schedule makes a lot of sense, so you can prioritize not only getting as many meetings out of visiting a region as possible, but making sure that the high priority diligence items are placed up front when you're figuring out what those priorities should be. So we don't find anything of concern or anything in best practice that we think is missing from your staff program, but we'll continue to be that third party assistance, not only to answer questions directly from the board, but to assist your staff as they go about managing these assets.
And I would just add that there's probably maybe an unappreciated connection between one of the slides your staff showed you, or it showed you the structure of your composite, your international equity composite, as if it was a standalone portfolio, and how it's diversified, not just across managers, but across styles and across cap sizes and across methodologies. We call this the axes of diversification. And the most important thing, we believe, for the board in terms of its oversight is not whether this manager at any given point is underperforming or outperforming, or how good this manager is, but how the composite, how the portfolio is doing as a whole, which is driven by the structure that was evidenced in the slides in the middle of the presentation. And those are the ones that really connect to the performance at the end. So I'll stop there.
Okay, thank you. Thank you. And you might as well not stop there. You might as well go on to your presentation.
Thank you, Mr. Chair. I will. I think I drew the long straw today to do this presentation, but Becky or Mark will chime in at will, especially when I go off the rails, as I'm prone to do from time to time. I'm surprised they're even letting me do this, but I'll give it a shot. So we're looking at the presentation called Capital Market Assumption and Asset Allocation Education. And the first thing I'll say is emphasize that this is an education presentation, but it is an important one that will be linked to the single most important risk and return decision that this board makes by a wide margin, both return and risk, and that is the asset allocation. I want to make it clear that there's multiple studies that show that this is the most important driver of the total return and the risk posture of the portfolio. It dwarfs everything else. And so it dwarfs manager selection, for example, because a good asset allocation will dominate and can make up for mediocre to poor manager selection. But great manager selection cannot overcome a bad asset allocation. And it's a challenge too for a board, because unlike managers, you can't go and do due diligence on an asset class. You can't do a site visit. You can't do a Zoom call with an asset class. And so there are special challenges in terms of wrapping your head around this most important decision. So I'll also say that the goal of an asset allocation is to create a diversified investment fund that does two things. One is it pursues returns to help fund benefits along with the contributions to the fund. And the second thing it does, though, it doesn't just pursue returns, but it protects the assets. Another goal is to protect the assets, contributions, plus those investment returns that now make up the fund that are pledged to the exclusive benefit of the beneficiaries, by subjecting them only to the risks that you as a board deem are prudent in the pursuit of those returns. So you want to pursue returns, but you have a simultaneous goal that you want to take risks that are only prudent in the sense that you have an obligation to protect the assets as well. So let's move to the second page, if we could. Let's move down to capital market assumptions. So in order to figure out what the future looks like for asset classes, there's nobody to interview because there are no people involved. Asset classes are collections of investment exposures. We have to make some judgments about what we expect from asset classes. So each year, RVK, we do a very deep dive into each of the asset and sub-asset classes, over 50 of them, to ask the question, what should we be, what is reasonable to expect from this asset class or this sub-asset class, whether it's high yield or US equity or core bonds or treasuries, and for the long run, because we're building a house here that's not just for this year. We're trying to build a structure that, while it may be renovated and changed and new windows put in over time, we want it to have legs going forward for multiple years, because this is a perpetual fund, and changing the entire structure of the fund is very expensive. So we ask of each asset class, what can we reasonably expect based for the return of the fund, for the return that an investor could get from the asset class? What's the risk that is reasonable to expect? And risk here is defined, as was your staff described it earlier, the volatility of returns. And we'll go back to why that's important. And then the third thing is how well they move together. And Carl, you asked a very good question about the two regimes that you saw in your staff's presentation for international. One regime showed a very similar performance, and another regime showed reasonable correlation, but the divergence itself drove the correlation to a higher level. So all three of these things are very important. Return, we know why return is important. Risk, we know why that's important, and I'll show you why it actually links to return. And correlation is one of the things that is a risk mitigator. It helps you control risk in the portfolio. So the other thing I would say about these assumptions that we use to try to create the map of expectations for asset classes that you might use in your asset allocation is that they assume no special manager skill, no excess returns, no alpha, either positive or negative. They're expectations for the asset class as if it were, if you could invest in it in its entirety. We do these updates annually because we don't want them to be out of date. When an asset class collapses, like equities did during COVID in March of last year, we immediately changed our forward-looking assumptions because the starting point had a massive change. So this is the way we keep our assumptions up to date. If we go to the next page, which is page 5 in our presentation, we talk about what it means to be accurate in these assumptions. And there's two types of accuracy. One is relative accuracy, and the other is absolute. Now, what do I mean by that? Relative accuracy is essentially getting the gap between the expected return for stocks versus bonds, or US equities versus foreign equities correct. It is the most important type of accuracy, much more important than the absolute return. And the absolute return is essentially what you would think it is. If we think equities are going to, US equities will, we should expect 7% returns. It's nice if it were 7%, but what we really care about is trying to make sure that 7% versus our expectation for bonds, for equity, for foreign equity, for real estate are correct. And the reason is that the asset allocation process is a competition that you are running as an investor. You are running this competition between asset classes to see which ones in what weighting would be the best ones to serve your interests, your investment objectives. And this competition is driven by expectations between the asset classes, not what the absolute level is. So for example, if you took our asset class assumptions and you raised them all, but kept the gaps the same, you would get pretty much the same portfolio. So absolute accuracy does matter, because if we were to encourage you to think that returns were going to be extremely high over the next 10 to 20 years, that would essentially be a signal to you to say, you know, we don't need so many contributions then maybe we could increase benefits. And so absolute accuracy matters in these forecasts, but relative accuracy is what builds the portfolio. Any questions there?
Really quick, if it's possible, just to share if people need to see the presentation, if it's possible to share the screen.
We can
Sorry to
do,
interrupt.
yeah, we can do that if you want. But
We have it, so.
okay, as long as every board member is following along page by page, I'm fine. So now we're on a page called Historical Perspective of Expected Returns. So what you see here is on the top panel is the range of 20-year annualized returns for selected asset classes. This is what occurred actually in a 20-year period, the lowest and the highest level. And you can see there's quite a spread. So where is our expectation for this same 10 to 20-year period going into the future? As you can see, it's far to the left, meaning our expectations are very cautionary with respect to the midpoint and the high points of what we've seen in past 20-year periods. And we'll explain a little bit why that's the case. If you look at the bottom panel on this page, you look at our current expected returns versus where our expected returns have been year by year, all the way back to 2007. And as you can see, we're as cautionary as we've ever been in this process. And we started this process in the modern way that we conducted today back then. So the message here is that you should expect, as we head into the capital markets discussion, that we're not going to be terribly optimistic about equaling recent achieved returns, much less exceeding them. If we move to the next page, and we're talking now page 7, and it's titled Key Themes. Every year when we delve into trying to create this map of expectations in which portfolios might be examined for the future, for their future performance, there's different issues that crop up that are prominent in our discussion. This year it was 3 things. One is it was inflation. As you know, inflation has been very muted, despite the fact that central banks, including our Fed, have thrown money into the economy as fast as they can possibly print it, it seems. And but the weight of debt and slower returns have kept inflation at a very low level. So much so that the Fed has said that its 2% target, which it has not reached until literally just this particular last inflation announcement, that they're willing to see inflation exceed that number for a period of time to try to average in at 2%. And we also know that we've never seen a period where so much stimulus has been heading into the economy at a time when the economy is actually expanding, in this case, re-expanding from its COVID recession. So there's quite an expectation in the marketplace for a short-term surge in inflation. But remember, we're trying to build this house for the long run and not for what happens this particular year. So while we debated whether or not we should raise our 2% expectation for inflation to 2.25%, we ended up, given the long time frame here, keeping it at 2%. Mean reversion is the other theme, and that plays into something that I think everybody will intuitively understand, and that is when returns surge way above their historical norms, as they have since the bottom of the COVID decline back in last year, that there tends to be a return toward normality. In the stat geeks that we are call it mean reversion. That means it reverts to a long-term trend. If that is what happens, and it is our general expectation going forward, then returns are likely to move back toward normal and maybe even below normal in order for the long-term trend to be reestablished. The last one, which you've heard about in past meetings from your CIO and your staff and us, and that is yields are very low. And so yield is often considered the return going forward for fixed income is often considered to be keyed largely off the current yield. And there's a phrase that we use called yield is destiny, and it's particularly true for anything in the fixed income world with durations of, say, 7 years and beyond. With the 10-year this morning opening at 1.6% and the 30-year Treasury at only 2.32%, and cash at zero, essentially, we can't escape the notion that that expectations for returns for fixed income asset classes are going to be lower. So we move to our next page, and don't be afraid to interrupt me with questions, because once I get on a roll, I'm hard to stop sometimes. I apologize for that. And it's titled RVK 2021 Compound Return Assumptions. I want to stress several words here. One is that these are returns that we haven't yet got into things like correlation, for example. And the word compound means that they take into account volatility. And we'll show you a page later that shows that volatility essentially is the enemy of long-term returns. Volatility erodes long-term returns, which is why we care about it. And so, and the other point that I would make is that when your actuary goes to the other boards and recommends a contribution rate that's built on his or her calculation of liabilities, as well as what the appropriate contribution should be given their expectation for appropriate long-term contributions, one of the things they look at are potential compound returns from investment returns from the portfolio. And they're looking at compound returns, not year-by-year returns. So if we move to the next page, you'll see it's titled RVK 2021 Assumptions, and we're comparing them to 2020 Q1, because what we're looking at is the change. And in normal years, there's not so much change in the market or in our future thinking that we see such a huge array of change as we see in this particular slide. If you look at the right, you can see the nominal return, the estimate of volatility risk, and the nominal return that's geometric. That means compound. Geometric and compound mean exactly the same thing. Though that's the change from where we were in the spring of last year. And if you recall, the spring of last year, we had raised our forward-looking assumptions because the stock market had collapsed as COVID hit. And we expected that the return to normality would be a positive one. Well, we've had that return to normality and then some, and then some. And so if you look at our forward-looking expectations for many asset classes, you can see that they are shaded in pink, which means that they are lower than what we set out in the first quarter of last year. So, so essentially, this is the numerical illustration of what we talked about earlier, which is cautionary expectations for where returns are likely to be going forward. Now, is this a prediction of a stock market crash or a real estate market crash? No, quite frankly, we're not that smart. In fact, quite the opposite. What it says is that we think that the change in to more normal return levels is likely to occur from these high valuations to more normal valuations gradually over time. There are many paths that return could take, that path back to normality. And it could happen in a heartbeat, as it did, by the way, in the crash of '87, in the major decline in 2000, 2001, in the great financial crisis, or it could happen very gradually. Not being smart enough to know when and how this is going to take place, we essentially spread that return to normality over a long period of time. and express it in annualized terms that you see in the third row from the right. The geometric returns you can see are consistently lower, and we'll talk about why that's the case in a moment. If we move to the next slide, it's called the capital markets line. This is the expression in graphical terms of an investment truism that basically says, if you want more return, you have to take more risk. If you don't want risk, you have to settle for less return, because the market prices returns into riskier assets at a higher level. So if you look at this slide, for example, let's look at the far left-hand side. You see the word cash in the lower left-hand corner? It's the lowest risk asset you can imagine. And guess what? It's the lowest return asset that you can imagine. Now go all the way to the right, and you'll see emerging market equity. You'll see private equity. You'll see small cap. You'll see international. You're going to see asset classes that tend to have higher volatility risk. And so the capital market line is essentially the line that connects expected return in the future to the amount of volatility risk in a given asset class. Notice that the blue line, which is where we are today, has rotated downward. What does that mean? That means that you're getting less return for these riskier assets because they have been priced higher, their valuations have been driven up, and so the future return from these risk assets, given the amount of volatility that one could expect, is less. That doesn't mean that they're not worth investing in. In fact, these are your choices. But what it does mean is that this rotation down is another graphical illustration of how high valuations have become across many of these risk assets. I'll stop and see if there are any questions. If not, we'll move on to the asset allocation competition itself. I'll stop for a moment, Carl.
Carl, this is Jack. I'd just like to make a comment more than a question, but I think it's critical that people understand that these assumptions on returns and other metrics are RVK assumptions, and that the Board of Investments themselves do not make predictions on returns. And I think sometimes people will look at our minutes and think that we're accepting these as an institution when we're not, and that could be critical. I don't know, Dan, if you think that's important, but.
Well, I guess it gets back to the point that I ask Jim every meeting, and that is, are the capital market assumptions interchangeable with the assumed rate of return that the pension board set? And Jim always tells me,
no.
There you go.
Absolutely not.
So that's a critical point. It's missed on some, but I think that continuing to point it out is absolutely important.
Yeah, in fact, Jack, this is an analysis that requires that we, as your advisor, make these assumptions in order so that we can present what we think will be the most likely outcomes for various asset allocations that you might choose. The decision you make is not to accept these assumptions or accept the analysis, but you do have to make an asset allocation decision in conjunction with your CIO and staff. And what we're doing here is to try to build a foundation for you to understand that decision as best as we can. Is that responsive, Jack?
Yeah, that's very good.
Okay. So now we're getting into asset allocation. One of the things that that folks struggle with about strategic asset allocation is that it is both a methodology that has its own rules, but it's also a methodology that's imperfect, and it's a methodology that can't run on its own any more than you would let any other computer program or methodology make all your decisions for you. And so it requires both quantitative analysis because it's disciplined and it's apples to apples across asset classes, but it also requires judgments to understand the weaknesses of the approach. So one of the things that if we go to the next page, this is the chart that I promised you to illustrate why we care about risk and why we care about volatility. Often, quite frankly, trustees will look at an asset allocation output and analysis and just glom right onto just the return numbers, especially the annual average expected return number, which is a number that it does come out of the process of the methodology, but it's not the one that you have to live with over the long run. And and the one you have to live with over the long run is powerfully affected by how much volatility there is in the portfolio, which is why RBK always shows you the standard deviation that's expected of every different asset allocation that you might consider. So this is why that's the case. So if you look at the chart on the left, the table on the left, you'll see portfolio one is a portfolio where the average return for 20 years is met every single year. It's 5%. So the average return and the compound return is the same return. Portfolio two, however, has the same average return, but it gets there in a wildly different way. There's 0 1 year, 10% another year, 0 1 year, 10% another. So it has the same average return, but oh my goodness, take a look at the blue line. What has happened to the compound return because of that 0, 10, 0, 10, 0, 10? It ends up at the end of 20 years with less money than the one that had no volatility at all. Then we move to the table again and go to portfolio three, which has even more volatility. So it still averages the same number, but all of a sudden now it's down 1 year, it's up 15% another, it's down another, so it's much more volatile. Now look to the right. Where does that portfolio lead you at the end of 20 years? Significantly lower than the portfolio that had no volatility. So that when we talk to you about our asset allocation outputs, we'll talk to you about return. And we'll talk to you about the average return, the arithmetic return. We'll talk to you about the geometric return. But we will link those by encouraging you to focus in on how volatile the portfolio is. So I hope that convinced you that volatility is the enemy of long-term returns. Now, that said, the earlier capital markets line I showed you that there are no asset classes that don't have some volatility. So volatility you can't escape from it entirely. In fact, the more the more volatility you build into your portfolio, the greater the expected return. And here's where correlation comes in. If you have to accept volatility, i.e. risk, to pursue return, how can you try to dampen it at the total portfolio level? And the way that you do that is to try to get asset classes that don't behave in sync. That is, they don't all go down, going to the previous chart or previous slide, all go down 5% at the same time, and then all go up 15% at the same time, and then the next year go down at 5%, but they have a path that is not correlated with the paths of the other major asset classes. So it essentially smooths the return of the total portfolio, meaning that the volatility penalty, that enemy of long-term return, gets squeezed a little bit, which is why they call diversification through correlation, through lack of lower correlations, essentially the only free lunch to be had in investing, where if you're careful, you can lower your total volatility and that total volatility penalty on returns without having to actually change the asset classes that you invest in pursuit of a return, so long as you choose those that are uncorrelated. So let's turn to the board itself. as I said at the very outset, you're trying to use the accumulated assets from contributions and prior year investment returns, minus of course the cash flows that have to go out to pay benefits, to try to essentially be another leg in the stool, in the funding stool for future benefit payments. And the other leg of the stool obviously is contributions. So you are trying to pursue returns, but this is where risk tolerance comes in. We've already had a discussion now about that excessive risk taking in terms of the volatility penalty actually is the enemy of returns. So there's a balance to be struck. And we haven't even gotten into the issue of short-term risk from portfolio volatility that we talk about when we look at short-term drawdowns and its effect on the fund's ability to make returns. Now we're just talking about the longer term. That's a whole separate kettle of fish, but we've talked about it often with respect to how much of the portfolio you can afford to put in illiquid alternative investments. And that is something that we'll deal with in great length in the asset liability study. So so we're looking at pursuing returns. We're looking at trying to constrain risk to a level that you as fiduciaries feel is prudent and reduce both the risk to the assets and the penalty that it can impose on long-term returns. And then of course you have to consider as well that the portfolio be liquid enough so that you can continue to pay benefits. And if your portfolio, as is the case with the pension plans in Montana, are cash flow negative, this is something that you have to keep your eye on as well. So all of these things play in trying to figure out what is a good or a bad or an acceptable or an unacceptable asset allocation to put in your array of choices. So
Jim, can I ask a question real quick?
Absolutely.
As we talk about the long term, we here tend to focus on how can we maximize the returns and minimize the losses because that's our portion of the funding equation. But now that we have the asset liability study underway, I want to get your feedback and your team's feedback on how the distributions, not necessarily on our side, but from the capital calls, but the beneficiary distributions will be taken into consideration. And I say that because as I look around just this office, 32 employees of 11,000 current state employees, most are on a variable rate GABA, if not a 1.5% GABA. And there are very, very few of us left on that higher 3%. So as we look at the asset allocation going forward, we've got our portion of the stool to uphold, but I just want to get a sense from you as to how that beneficiary outflow will be taken into consideration within the context of the asset liability study.
Absolutely. And this is where, in fact, this very week as we talk, Kavanaugh McDonald is conveying the actuarial liability estimates that they make over to our asset liability team. So, as we've sometimes said in the past, an asset liability study is the gold standard for assessing the current and future health of a defined benefit plan. And it is precisely for the reason that underlies your question, in that it looks at investment returns, we call the asset side, but it also simultaneously is looking at the outflows that are expected. And we do that by essentially in the study replicating to a fine point the liabilities estimated by the system's actuary. And not just in general, but literally year by year at the individual level. We don't know the individuals, we don't have any individual data, but we have the individual payment records. And what we're looking for here that gets to the heart of your question is the payout ratio. And the payout ratio is the net outflow from the fund, net of investment gains, net of benefit payments, net of any other depart cash flows that would leave the fund. And that payout ratio tells you a great deal about what types of risks you are wise or unwise to take, or if it's, and to what degree. And so that's what you can expect from an asset liability study. The one we did for you 10 years ago suggested that over a period of 20 years, gradually over time, the payout ratio would rise if nothing else changed, and that you would begin to approach the point where the optimal level of how much of the assets could be in illiquid form could be reached. Now, we'll have another test of that later on this year when we complete the asset liability study, but it will be it has implications for illiquidity versus, or liquid versus illiquid assets. It has implications for volatile versus less volatile portfolios. I think you'll find it very, very useful. Dan, was that responsive enough?
Yeah, I think so. I just wanted to make sure the board knew because very few of the board members were around the last time we did an asset liability study. Also, all of the fixes that came in the 2013 legislative session weren't around for the last study. So we were still at a 1.5% GABA. There was no variable rate GABAs in. There was no supplemental contributions. None of those things existed under the last study. So, as you've seen in inception to date, we're hitting our actuarial benchmark, knock on wood, John, no pressure. But the other side of the ledger has gotten better as well. So,
and that will make a difference, Dan. We actually had the state of Michigan had major reforms in their liability side that had nothing to do with the investments. They had a huge early retirement program and made a number of other changes that they were able to do under their statutes and constitution. And they actually had us do pre and post asset liability studies. And you're correct. It's not only the asset side that can change essentially the gold standard report card, but it also changes on the benefits side as well. But we assume that those have to be captured and will be captured and are captured in the actuary's most current valuation for the plan. Okay?
Yep.
All right. So we're on a page called Purpose for the Investments. You can see that every asset class has different characteristics. Take private investments, for example. We know that it's a liquid, but we also know it's been your highest returning asset class for a long period of time. We characterize that as capital appreciation. It's one of the legs that helps the total portfolio pursue return objectives that you might have. International equity and domestic equity have the advantage that at least over a longer period of time, they can adjust to higher price levels and reestablish earnings margins and hopefully valuation. We know that fixed income at the bottom tends to preserve capital. A bad fixed income market might be down single digits, but a bad equity market could be down 30 or 40 or historically even 50%. So the ability of fixed income to preserve assets and to perform the function, one of the functions that you have for asset allocation, which is to protect the assets under your care, plays a role in the portfolio, even if at the current time, it's not really producing much in the way of returns. So let's move to the asset allocation study itself. And we're moving to a slide called mean variance optimization. I mentioned before that it's a tool. Lots of people have said, oh, there must be a better way. There must be a better way. So far, no one has come up with a better way. It still is the standard technique for essentially, you see the word trade-off under the pros. This is what I said before about the competition that you are running as an institutional investor for where you're going to allocate your assets to what asset classes. It's as though you were the general manager of a baseball team and you're trying to figure out where to spend your money on that heavy hitting first baseman or that terrific fielding shortstop or that right fielder that has a gun for an arm. You have to have some of each of those things, but at any point in time, you have choices about sort of how much to pay for either one of those attributes. Same is true as an asset owner when you're building an asset allocation. The cons are also well known. We've done some big studies of what the shortcomings are, and we have some ways to ameliorate that. But we know that these are assumptions, and that the assumptions create a margin of error. So we should not take these, we should be careful not to assume a level of false precision. Directionally, we have confidence in these things, but with respect down to the last decimal point, that's unreasonable of the process. It also doesn't, the mathematical techniques assume that everything is distributed symmetrically around a center point. That's not true. We know that there are bad markets. There are not many of them, but they're bad enough, and they're out on what we call the left tail, the negative tail, that wouldn't be there and make the distribution not quite as symmetric as it should be. There's a bump out there of bad markets in the equity market. And that's our fix for that is to use non-normal distributions in our analysis. It doesn't include certain types of risk. Like it assumes that all the asset classes are equally liquid, which we know is not true. So we have something called the liquidity metric that we include to give you a sense of at least the relative liquidity or illiquidity of any asset allocation that you're considering. It assumes that asset class correlations, the ones that we use, those assumptions we talked about before, never change in the analysis over this period of time that we're forecasting. But historically, we know they do. No one knows how to predict when and how that's going to be the case, however. They are very sensitive to input changes, and this is why we use judgments. We use hard stops that prevent the model from using an assumption to essentially put most of your assets in one asset class and little and nothing else. That fails the test of diversification. And obviously, as mentioned before, it doesn't assume that you're successful or unsuccessful in your the building of your composites, your asset class composites, and your selection of managers, or your rebalancing policy for that matter, to add to value above and beyond what you see here. So when we look at these assumptions and we feed them into the model, you can see that we ask the model to several questions, which are on the page called Efficient Portfolios Asset Allocation Study Results. And again, this is education, but on the far right, you see your current, the far right column is your current asset allocation. And we asked the computer to essentially look through 10 other ones from low risk, low volatility, low return to high volatility, higher return ones to essentially create a picture of the possible outcomes that present themselves. Now, we don't let the computer run amok. You see those min and max numbers on the far left-hand side, those two columns. These are the hard stops I'm talking about, where we don't let the computer, even if it wants to, we don't let it put more than 38% in US equities. And we don't let it put less than 24%. And you can see that we have hard stops up and down the line for each of these that are reasonableness tests. We simply make the assumption that if you're going to have a real assets portfolio, that it's not going to be less than 1% of the portfolio. So we don't let the computer take it to zero. On the other hand, we know that you need returns, so we don't let the computer go above 28% in fixed income. So these are judgments that are made and they can be changed. They're not fixed in stone and they don't come about through an analytic process. It's more a judgment process based on information that we have about your portfolio, your circumstances, and your objective. So the way to read this is on the far right-hand side, let's look at your current asset allocation. You can see that these are the allocations of value, that is dollars, to each of these asset classes in your portfolio. And of course, they have to add to 100. That's the total portfolio. As we go on down that column on the far right-hand side, the first thing we see is a panel that has 4 rows in it. This is a way to look at the portfolio, essentially, you might say through the eyes of purpose or nature. That is, it's a lens, we call it a thematic look at the portfolio. And it simply asks the question in a relatively undisciplined way, because it's not super quantitative, but it does give an understandable picture of this asset allocation. And what it says is that this allocation devotes 68% of the fund's total dollars in the pursuit of capital appreciation. It devotes 18% to asset classes that we would call preservation assets. Alpha is an asset, is a thematic exposure that does not have a beta associated with it. You heard the term beta earlier. A beta is simply the characteristic of return that's simply associated with the asset class. Fixed income, equity, they have betas associated with them. There are types of investments, typically hedge funds, that wipe out this beta and that only return whatever skill the manager has or doesn't have. You don't have those investments. That's why that's 0. And then you have inflation mitigation. I don't want to call it protection because nothing really protects you against inflation as an investor, but its effects, its negative effects can at least be somewhat ameliorated. And you have 14% of your dollars devoted to exposures whose lead attribute is to mitigate inflation. So now, any questions about thematic view of the portfolio? Now we're going to get a different view in the next panel down. Okay.
Jim, I would just say, you stated it well in a number of times here, but I just want to emphasize that, be careful about looking at the actual numbers here that we're showing that we're going to return, because there are a lot of, as Jim well pointed out, cons associated with the MVO analysis and a lot of assumptions, and it's very sensitive to a lot of those assumptions. So if we tweak things, just a small bit one way or the other, we could pretty dramatically potentially change the numbers. So I don't want people to take away from this that our expected return is, X, Y, or Z off of this table, because I think that's a bit misleading. It is, as Jim has noted, more of a study to determine, is this a reasonable asset allocation based on, kind of where we would want to be in our risk tolerances. And so the focus should be there instead of raw numbers that we're looking at.
Another way to look at this too, and I know this has been brought up before, is the time horizon. So when you look at the actuarially calculated return assumptions, they are a longer time horizon. And the way that plays out is looking at our assumptions. One thing that goes into, particularly with equities, is mean reversion. And the more you stretch out that mean reversion, the less of a negative impact it has on the equity return. So that's something to keep in mind as well.
Yeah, thank you, John. And we don't disagree with a word that you said. Here's the deal. Absent an analysis like this, you're flying by the seat of your pants. So the one thing, as we said before, that the asset allocation, what we as geeks call the mean variance optimization methodology, at least gives you a apples to apples treatment of all asset classes under the same set of assumptions, under the same rules and the same methodology. So no other process really does that for you. So it doesn't supplant judgment, and it should not give you a sense of false accuracy. But what it should do is give you some directional information about the kind of asset allocation that you're most comfortable with, given your dual objectives, which is to pursue returns, but only at prudent risk to the assets that you oversee. So that brings us down to the next to the last panel, again, sticking to the right-hand column. The arithmetic return, this comports to the return that you saw earlier, which we would call the average annual return. This is what you would expect in any given year from this asset allocation, with the assumptions that we made, which we could be wrong. But we try to be as right as we can, and they're better than nothing. The expected risk is that volatility number that I talked about. Remember, I said volatility is the enemy of long-term return. So the next number down that you see, that 5.25, is what you would expect from a portfolio that had this average return, but this much variability, volatility, 11.87% standard deviation over a 20-year period. And as you can see, 5.91 gets penalized down to 5.25. Now, is this the right number? We'll find out in 10 to 20 years. But since we now have a chairman that allows me an unlimited metaphor budget, I would use the metaphor that I've used sometimes, which is, you're trying to get to Oregon on the Oregon Trail. You're starting off from St. Louis, from the Mississippi River, and you need a map. And the map is fraught with errors that are wrong and big holes. It's kind of like our assumption set. It's uncertain. But a map that has some valuable information is better than no map at all. And this is the map. This is the way we try to create a map to help you make the most important decision that you can make in your role as a board of investment. So now let's move down to the final panel. What do these say? Well, these are numbers, again, on the far right-hand column, that tell you a little bit about essentially the characteristics of the total portfolio that aren't associated with either its thematic aspects. We already dealt with that: appreciation, preservation, inflation mitigation, nor its arithmetic or compound returns, but more other characteristics that we have added to try to essentially give you more information about a given asset allocation. So for example, the expected return risk ratio is like an efficiency ratio. It's how much arithmetic return you're getting for how much vol you're accepting, that you expect. And so you can see that less, if you go to the far left, I'll get there in a minute. I want to complete the far right column. So the next one is the expected equity beta. What does that tell you? It tells you how sensitive the total portfolio, if it's constructed with this asset allocation, will be to the stock market. Essentially, it's like a correlation matrix. It means that when the market moves 100%, this portfolio is going to move 70%. So it's going to be fairly well correlated with the equity market. And you've seen that in your own performance reports that we've gone over in past years. And then the last one is a metric that we use to essentially make up for the blind spot that this methodology has for liquidity versus illiquidity. Remember, I said that the mathematical model assumes that all of these asset classes are just as easily tradable as cash. Everything is as liquid as everything else, which we know is not true. So what we do is we go through this portfolio, exposure by exposure, and assign a liquidity metric to it. It's not precisely accurate, but it's directionally pretty good. It basically says, yeah, cash is really, really liquid. It gets 100. But guess what? Private equity is not very liquid. It's not totally illiquid. You could do a secondary offering and sell your portfolio, but that's not an easy thing to do, and it can be very costly. So it gets a 5. So the more illiquids you have, the lower that number gets. And 70 is the number that pops out, and it can be compared to other asset allocations or other funds to see how liquid you are. And it can also be compared to your payout ratio that emerges from your asset liability study that we talked about earlier, and how important that is in judging how much illiquid exposure your total portfolio is wise to contain. Now let me talk about going left to right. Left to right, the portfolios, if we go through 1 through 10, these are hypothetical portfolios that the computer dreams up on its own based on a specific rule. And that is, for a given level of risk, it's the highest returning portfolio in that risk neighborhood that it can calculate. And it looks at thousands and thousands of different portfolios and picks out the ones that essentially are the most efficient. Most efficient means biggest return for a given level of risk, or for a given level of return, the least amount of risk that you can find in an asset allocation of the thousands that we ask the computer to look at. So characteristics we can see, conservative portfolios, if you go down to the 3rd row from the bottom, can be very risk efficient. The problem is they don't yield very much, but you do get return for the risk that you're taking, because you're not taking a whole lot of volatility risk. And you can see that as you move to the right, you're getting more return, but you have to take on incrementally more and more risk to get that return, according to the assumptions that we've made. You also note that that as portfolios pursue higher returns, like portfolios 8, 9, and 10, if we go down to the bottom row, we can see that those portfolios, to get that higher expected return, have to rely more on things like private equity and other less liquid assets. So they are not as liquid as conservative portfolios or your current portfolio. So this is, when it comes time for you to compare portfolios, we'll revisit what all of these metrics are, because each one of them, we hope, conveys a piece of information directionally about the nature of the asset allocation you're considering, and helps you understand what the consequences might be for selecting it. Now, the next page, if I could, is called the Asset Allocation Study Results, and it's a chart, and it has a big long line called the Efficient Frontier. And remember I said the computer generated those 10 portfolios according to a rule that we gave it. And that rule is that for a given level of risk, it's the highest returning portfolio that it can find. So risk is on the x-axis, that is volatility, and return is on the y-axis, the vertical axis. So let's look at 12 down on the x-axis. If you go up and you look at, say, something close to portfolio 7, what the computer is saying is it looked at thousands and thousands of combinations, and it cannot find a portfolio that an asset allocation combination that for roughly, I guess, 11.8 vol, that is just a little bit lower than 12, that has a higher return than you see in portfolio 7. So in essence, what the computer is telling us, doing all of these combinations, thousands, it cannot find any portfolios, any combinations that exist above that line. So we call that the efficient frontier. Every portfolio that sits right on that line is as efficient as it can get. It promises, I shouldn't say promises, it expects the highest level of return for that level of risk that it sits on top of over the x-axis. So, so there are lots of portfolios underneath it. Those are all suboptimal portfolios, meaning that there's always an opportunity, theoretically, to either get a return that's higher for that level of risk, or to get that same level of risk and at a lower, same level of return, but at a lower risk. So let's look at your current portfolio. The good news about your current portfolio is that it's up close to where the efficient frontier is, where the computer is telling you that it can't find anything more efficient than what it sees on that line. So when we see a current portfolio that's that close to the efficient frontier, we feel pretty good about its efficiency, at least based on the assumptions that we have. Now, is it possible to get something more efficient? Sure. Slide that green square a little bit to the left, but not down, and you reduce expected volatility, expected risk. But if you don't move it, drop it down, you're expecting the same return. Or if you move it straight up, you're not increasing risk, but you're increasing the expected return. Now that's easy. The closer you are to the efficient frontier, the harder it is to achieve that, though, in a pragmatic sense. And we'll talk about pragmatism in a little while. Now, the next, any questions about the efficient frontier? When we come back when your staff and we come back with actual options for you to look at and to discuss, you'll see many more squares underneath the efficient frontier that represent possible combinations that may or may not, in your eyes, be improvements over the current portfolio. But that's what you should expect. You should expect to see portfolios that are still close to the line, maybe even a little closer, but that are achievable from a pragmatic sense, and that don't require terrific disruption of your current asset allocation, which we can see already represents a pretty efficient portfolio. Now we get into in the next page, it's called Asset Allocation Study Results, Monte Carlo Analysis. Oh boy, this is a tough one. This is basically the analysis of risk in the asset allocation process that goes beyond a single number. And what it says is that what can we expect from a given asset allocation in terms of its worst possible outcome, its best possible outcome, and its most likely outcome. So let's look again at the far right, because it's easier to track that, the far right column, and let's go down to where you see the last panel, which is over 10 years. We conduct an analysis that asks this question of really bad outcomes, really good outcomes, what's the probability of those, and what's the most likely outcome in the center, the median. That's the 50th percentile. So as you can see, that 514 number that you see there comports very closely to the 525 number that you see in the slide before. It's very close. There are some differences simply because it's math rounding when we do thousands of iterations. But basically what it says is that if that's the expected, the most likely, the 50th percentile, the mean expected value for a portfolio, well, how big is the dispersion around that you might face over 10 years? Well, over 10 years, you could run into a bad spate of a bad 10-year period, such as we did from 2000 to 2009, when in fact the return on the S&P 500 was about 0. And you can see that there's the 1 percentile, 1 in 100 chance that you could actually have a negative return over a 10-year period. That doesn't mean every year would be negative. That means that the compound return over 10 years would be negative. And you can also see that if you go down to the very bottom right-hand corner you can see that the 90th percentile, I'm sorry, the 99th percentile, there is a tiny chance that you could have a spectacular 10-year period in front of you, and that you could earn over 13% per year annually. Doesn't mean that every year would be 13%, but it means the compound return would be 13%. So this gives you a picture of the sort of range of outcomes and their probability. The 1 percentile and 99th percentile are not very probable, but the 25th percentile and the 75th percentile are somewhat more probable. So think of this as a distribution around that 5.41 number that's fat right around it, i.e. the 25th percentile and the 75th percentile, but then gets really skinny as it goes out and becomes less probable. Now let's do the same analysis. If we go up to the top panel and we will ask the same question, not for over 10 years, but what if we ask it over a single year? Over a single year, the outcomes for a given year can be much, much broader. Because over 10 years, remember we talked about reversion to the mean? Over 10 years, things tend to even out if they're given time, which means that that tail that was from a slight negative to a 13% it seemed big, but now look at it for 1 year. In any 1 year, anything could happen. You could have a year of a 99th percentile where you got a 33% return, and it has happened. You could have a year in which the returns were negative to the point of almost 27%. That's possible. This is why it is so hard to predict what will happen in any given year, but somewhat, and I put that somewhat in quotations, easier to predict what is more likely to happen over a 10-year period. In the short run, uncertainty is very, very high. In the long run, it's much lower. And a lot of people think that it's just the opposite. No, in the short run, I mean, I'm close to it. I can see it. I'm pretty sure I know what'll happen. Statistics and actual experience tells us that exactly the opposite is true. That it is much easier to get a closer estimation of what the long-term trend might be than it is to predict what will happen in any given year. So this gives you some sense. I'm not going to go into the appendix. That's for your edification, and I know that you really like to read this stuff in the evening. Becky and Mark and I do it all the time. We can't get enough of it. So I'll stop there and see if there are any questions. But first, I'll ask Becky or Mark if there's anything that they wanted to add to my presentation or any errors that I made that need to be corrected, which I have made a few on occasion.
I don't really have anything to add, but if there are questions.
Yeah, same. Great job, Jim. So let's take your questions.
My question to Jim is that since he put me through this, I expect a really nice bottle of wine someday.
I think I'm willing to share a really good bottle of wine with anybody that puts up with me. Anybody. I do it with my wife all the time.
Under $15.
Yeah.
I'll take that under advisement. And I
guess
just
the
want to
only
thank.
thing, just maybe a closing comment is, having gone through this a lot, and Jim and Becky have gone through it more than I have, but the most important thing seems to be really understanding your objectives at a very deep level, and designing a portfolio for the long term that's going to meet those objectives. And then where we see people get in trouble sometimes is not designing a portfolio that doesn't recognize their short-term constraints. And those can be technical constraints, but to be honest with you, more often they're psychological constraints, in that there's a temptation when things get really bubbly or when things get really hairy to question whether you had the right allocation, and that's generally precisely the wrong time to do it. There's a good quote from David Swenson, who's widely regarded as the best institutional investor out there. when describing asset allocation, he has a good quote. I have it on my wall because it's so good. Is lightly held positions invite casual reversal, exposing vacillating investors to the costly consequences of market whipsaw. The translation of that is if you haven't designed an allocation that matches the long-term and recognizes your short-term constraints, and you're not confident in it, that's going to tempt you to sell low and buy high, which is the worst thing that you can do. So the asset allocation process is not precise. This is a good framework, but that's the most important thing to remember when you're designing an allocation.
I guess I have a question, Jim. If you go back to slide 15, and you've got our objectives and constraints. You say that the fund has a moderate to high tolerance for risk. I've never thought that we had a high tolerance for risk. I mean, what does that mean? Or why do you say we have a high tolerance for risk?
Well, a couple of things. One is that you're a perpetual fund. And so perpetual funds with a ongoing contribution stream and an open DB plan should, if they're to meet their objectives, have a pretty reasonable risk posture. And because they're essentially chasing the benefit rabbit. And so it's not inappropriate to have at least a moderate appetite for risk. The second thing is that just observing this board over a number of years, you have been willing as trustees to tolerate two of the, I should say maybe three exposures to asset classes that are partially uncorrelated, but in all cases, would tend to carry more risk than, say, for example, fixed income or core real estate. And those would be equity, both US and international, public equity, private equity, and emerging markets equity. So I think that it's a fair assessment of what we've observed so far, and it's not unusual to see a board in your situation trying to make sure that the investment leg of the stool is appropriately tuned to this balance between pursuing returns to fund benefits, but protecting the assets. And I think that the record shows that you've done a good job. So this moderate to high is these are relative?
It's kind of an absolute scale.
It's not an absolute scale. It's a relative scale. But I would also say that if you look at your...
So you're saying that compared to other perpetual investment firms, other perpetual investment funds, we have a high tolerance for risk?
Compared to a corporate DB plan, the answer is almost assuredly yes in most cases. Compared to an extremely well-funded or overfunded public plan, they could very well be the case. But this is these are terms that don't have quantitative meaning per se, but they can have quantitative meaning. If you would like us to, when we come back to talk about this, remember I said that the asset allocation, any asset allocation, including your current one or any other that you would look at, has an expected volatility. That's one measure of risk. What we can do is we can match that against what we observe with lots of other funds that are open DB plans, that are in your size range so that they have the same general access to asset classes as you do. I think what you'll see is that compared to those funds, you're probably very close to right in line. You may recall that when we do performance reports, there's a page in your performance report that we talk about called the equity beta line. Remember, equity beta is one of those measures that are in every asset allocation analysis that we present to you for every asset allocation you might consider. And that equity beta line is a reflection of the sensitivity to the stock market. And the stock market is by far the source of most of the volatility in institutional portfolios, including yours. And when I say most, our historical analysis is that it accounts for anywhere from 70 to as much as 90% of the volatility of the total funds number. So I wouldn't key off too much off those words. We'll be able to talk more about in more clear definition about risk posture and how you feel about it.
Okay, thank you. Anything else from anybody? If not, Jim, thank you very much. I thought that was it. Very good. I've heard it before, and I'm glad there's not a quiz, but I think I'm beginning to understand it more and more. Let's see, Dan, wrap up.
A few things I owe the board. One, we will get the revisions to the COOP and internal control plans incorporated and emailed to you. Couple things I need from the board members. We are being forced to update the website due to state of Montana IT changes. I just need to know from all of you whether or not you want your pictures on the website and what contact information you want provided. At a minimum, we have to have emails, but if you want phone numbers, other things, just either catch me or email me with what you'd like for board member front page on the website. I emailed you most of the things we discussed this morning during the lunch hour, but I will do a little thinking on the exit interview process that Director Fladmo asked about and get some thoughts out to you all sooner rather than later.
And Dan, I'd say if you guys think through the administrative role stuff and think that we're just extending it too far, that we can revisit that again. This is not something we have to deal with immediately.
Yep, I appreciate that. We'll mull it over internally and.
Right, I think you understand what our concern is that.
Oh, yeah.
Yeah, so.
I shouldn't be able to start your process.
Right.
And that's.
Nobody wants to be taken by surprise, and you know, of course, we trust you implicitly that you're not going to do it, but future boards, future things, you know. So.
Yep.
Anything else from anybody? Anybody remember anything that we, in the recap that has been forgotten? And then we meet again in June, is that right?
Yep, June 1st and 2nd. Depending on everybody's vaccination status and general comfort, staff will continue to Zoom in. However, we'll have the boardroom set up for the board members and John and I to be with you if that's your preference to travel. But staff will be Zooming in unless they're presenting, and then they'll come join us in the boardroom so that you can have a chance to interact with everybody at a face-to-face level. And RVK, clearly whatever your travel permissions and preferences are, we will absolutely accommodate you.
And that's that we got a full agenda in June.
Oh, June and August are going to be brutal.
Full. Let's call it full.
Fun.
Fun.
And unless there's anything else, going once, going twice, everybody be safe. And I think hopefully we'll can see at least more people in person in June.
All right. Thank you.
All right. Thank you
Thank you,
all.
everybody. Bye-bye.